see if you are able to locate this question. The bond has 5 years to maturity. Coupon rate of bond is 15%, payable annually. Current price is 1025.86. YTM given 14.24%. Face value is 1000. Compute the duration and volatility. So how do we go for duration? Duration is nothing but a weighted average. So we will have regular column for year, and then we will have the regular column for cash flow. That's what we used to have it earlier for valuation of bond. Discounting factor and discounted cash flow. Standard column. But discounting factor, you should always be careful. It should be at YTM for calculating duration. Because duration, volatility, YTM, all the three are from instrument point of view. So those three should go hand in hand. And then this year column for us is X. That is the number we are trying to calculate average for. And discounted column, discounted cash flow, this is the weight for us. And for weighted average, we need to multiply X into W. That means we will do this DCF column multiplied by year column. X is year column multiplied by DCF. This is what we require for solving this. Have one more column ready, or keep the space for one more column, because to compute the convexity, one more formula we have written, that is W x plus 1 into x W something. So that one more formula we require, so keep one more column space. Don't exhaust the space. So let's have the year as 1, 2, 3, 4, 5. Cash flow as coupons 150, 150, 150, and last year 1150. This you can't do using annuity factor method. You have to solve year by year separate. Discounting factor 14.24%. So 1 by 1.1424 equal to every year. Discount cash flow 150 into 0.8754, 151. into 0.8754. You can take decimals also. I'm rounding it off. 150 into 0.7663. So year column is like X, and DCF column is like W, and we are doing a product. So total for verification you can do, is it 1026 approximately? That should be the case, because that is what is your approximate market price. The sum should be approximately equal to the market price. This is just more of a verification. Then last column will be year column multiplied by DCF. The X multiplied by weight. So 131 into 1, 131, 115 into 2, and so on, and then do the total. So what are the total? 3971. Then we'll go for duration. The product column divided by the sum of weights. Sum of weights nothing but market price. That is 3971 by 1026, 3.87 years. Then volatility, duration by 1 plus YTM. Duration what we just calculated, 3.87 divided by 1 plus 0.1424, that is 3.388. You better understand this 3.388 as times. It's a ratio, and even though we have not written, you should remember it is minus. Inverse relationship. And interpretation, you know, if YTM changes by 1%, market price should change approximately by 3.388%. Both upside also, downside also, which means this is force fitting linear relationship. If it is up by 1% also, we say 3.388%. If YTM down by 1% also, we say impact is 3.388%. On both sides, we are telling same impact. And that is what is forcefully the linear relationship. But in general, but remember the concept, in general, whenever YTM reduce, the market price should increase. This concept holds good not only for bond, in general for valuation of bond, for valuation of assets in financial management, because there is always inverse relationship between discounting rate and present value. There's one concept again in FR, I'll just try to link it now. There's one something called as impairment. When we're trying to compute the impairment, we compute the value of the asset, and for that we look for various indicators. Various indicators represent the value of asset has gone down. Various examples. One of them is interest rates. Interest rates in the market. So can you tell me, when an asset has to be impaired, which is an indicator of reduction in the value of the asset? Increase in the interest rates or fall in the interest rates? Which indicates reduction in the value of the asset? It is rise in the interest rates, because we just see that is the inverse relationship. That is a basic you need to understand. When interest rate increase, value of the asset don't increase. When the interest rate increase, the value of the asset decrease. That is the inverse relationship between discounting rate and value of the asset. Therefore, even in FR impairment, when we test, a reduction in the interest rate is not an indicator. An increase in the interest rate in the market is one of the indicators. It's not that it is a foolproof, but one of the indicators that the asset has gone down. To pull to real life now, what is happening in real life now? YTM. Recently, the RBI has reduced repo rates, the rate at which the RBI borrows, repo rates. When RBI only reducing the interest rates, the banks also will reduce the interest rate, because that we take it as a base rate. RBI is equivalent to government. And when all interest rate reduces, the price also will increase. Now, a small case study kind of thing. You have a bond which will have a lesser duration, or you will have a bond with higher duration. One bond, let's say, has 3.87 years duration. one more bond, let's say it has just 1 year duration. Two bonds having different duration. Now when RBI changes the repo rate, YTM also will change. Now, which would have been affected most? A bond which is having a higher duration is influenced most, or bond with a lower duration influenced most? We just understood this is the volatility. That is, if let's say bond duration, let's say volatility only. For simplicity's sake, let's say volatility, because higher duration means higher volatility also. Let's say this is 3, this is 1. Which will react more? When RBI changes its interest rates, what reacts more is obviously bond with a higher duration, because bond with higher duration means they have more cash flows, more present values, more calculations. That is why this term you understand. Volatility. Higher the volatility, higher the responsiveness. So when RBI changes by a small basis points, this volatility will change, which means the bond with higher duration. So you can just remember, higher the duration, higher the volatility, as well as higher the risk. When you invest in a bond with higher duration, you're also having a higher risk. Simple example, let's say you're putting a fixed deposit. You're having a fixed deposit of 10 year, or you're putting a fixed deposit of 3 year. Where do you think risk is more? You may think, no, 10 year my interest rate is fixed, I am more safer. But what happens when the market changes, your interest rate don't change. But after 3 year means new rate will apply. So this 3 year fixed deposit is more in line with the market changes. Whereas longer the duration, it is not responding to the market changes. So that is actually more riskier as when you compare to a longer duration. So in general, what you need to understand is, higher the duration, higher the volatility, higher the risk. So if you are investing, or you are recommending your clients to invest in a fixed income security, recommend to invest in a lower duration bonds. You should not invest in a higher duration bonds. But as an individuals, can we invest in bonds? In India, that is not yet available. I can invest in shares of a company. I cannot invest in bonds of a company as of now, at this point in time. So I cannot go to Demat account and search for Reliance bond, and I cannot apply it. So what you can do is, you can invest in mutual funds, and mutual funds can invest in various bonds. So basically you're not investing in one bond, you're investing in a portfolio of bond. But the logic concept holds good there also. So as an individual, when you're trying to apply, what you should look at is the duration of mutual funds, the volatility of mutual funds, whatever YTM of the mutual funds, and debt mutual funds, to be more specific. In the mutual funds, we have different kinds of debt mutual funds. Debt mutual funds means should invest only in bonds, but they're also having restriction. They are having liquid mutual funds, meaning they can invest only in a bond which is having a maturity less than 90 days. They cannot invest more. They have something called as long duration bonds, long duration mutual funds. They can invest only in the securities which is having a maturity period or duration beyond a certain number of years. So for if you, as an individual, if you want to invest, you should go for mutual funds. And that, if somebody recommends where should you invest, you should better say invest in liquid mutual funds, because that duration will be very, very less. And as you increase your higher duration, that means you will have a higher risk in hand. Okay, now this, let us go for some alternative methods. We learnt in the basics of average. How did we calculate a weighted average formula? X bar equals summation XW divided by summation W. That's what we did now, product by market price. That is nothing but the weight. One more method also I told you, remember, third method, where we convert the weights into proportions, probabilities, where we converted summation x into p. We did not have to divide anything because that proportion itself will take care of all the multiplication. Now in this case, which is the W column? Oh, you would have identified already. DCF is the weight column. So instead of multiplying by weight separately, we can convert it to proportions. Have one more column. That is what? DCF divided by total. That is 131 divided by 1026. Don't do it. I'm just telling you. You can try it later. 115 divided by 1026. 101 divided by 1026. You will get one more column. In the exam, I don't recommend because it's extra one step. But what you get is weight column or proportion column. That proportion column I can multiply it by years. That should also give you the same answer. I've done it already. Just understand. You don't have to write it. The whatever DCF column I've converted into weights. 131 by 1026. Just compute and see if you get those numbers. No need to write. It's only for your reference. 115 by 1026. You get this. And total of the weight should add up to 1. That is the proportion. Then we multiply this weight with the year. That is a product. We get the same answer. The reason why I'm telling this is, suppose you look at institute solutions. They would have given the answer like this. But it is unnecessary, one extra step. I don't recommend. But if they have given, you should be aware of it. So I'm telling you nothing more than that. In some textbooks, not in institute solution, some textbook would have given this answer also. So that also I'll discuss with you. As of now, we used product column. How this product column is obtained? By multiplying year and DCF. How did you obtain DCF column? By multiplying the discounting factor and the cash flow. So instead of doing these three things, can't I do directly this year into discounting factor into discounted cash flow? Discounting factor. Anyway, we get the same because everything is multiplied anyways. And if you want total of this, that anyway, no, that will be market price. So in some textbooks, they would have awarded this column and taken these three columns, multiply, you get the number and divide by market price. I don't recommend that, though it saves time, because that is not very conceptual. Because we should always verify this total should adapt to market price. It's a kind of verification for us. In some problem, they'll ask you compute market price. So among the, we don't have to go to institute method where weight is one extra column. We don't have to go to some textbook methods where this column is omitted. This is the appropriate method from exam point of view. And one more thing I told you, we can also calculate using the shortcut method. Let us use that one, where remembering might take some time, but it saves lot of time. So duration, shortcut formula you can write. You know, YTM is yield to maturity, C stands for coupon rate. Time period means time to maturity. Again, many people don't believe it's a shortcut, but you have to trust yourself. It is a shortcut. See, this is a bond with 5 years. So you read 5 row. If the bond has 25 years, in examination they may not ask. But in exam they can ask 10 years. 10 years but coupon paid semi-annually. You require 20 lines. You can't use annuity factor. So those cases, this shortcut is helpful. This shortcut is only so much whether the bond is 2 years, 20 years, or even 200 years. Let us substitute now. YTM is 0.1424, 14.24. So this will become 1 plus 0.1424 divided by 0.1424. We'll put bracket for more clarity. Minus 1 plus again 0.1424 plus time period means 5 years into C, coupon rate. Because we are doing 0.14, let me do 0.15. Coupon rate is 15%, minus 0.1424. Second part, I'll just put full bracket, whole divided by C, 0.15 into 1 plus YTM, that is 1 plus 0.1424 to the power of 5 minus 1. Plus 1.1424. So this is one part, this is another part. Simplify. So first part, what numerator you get? 8.027, and the second part numerator 1.1804 and divide by 0.2843. See if you get the same answer. 3.87 years. Minus 1 and then multiplied by 0.15. No, you don't do GT. It's not sum. It's just the last number, fifth year. 1.1424 into, do it 5 times you multiply, and minus 1. No, just into. 5 times you have to multiply. Still not getting? Got it. Okay. So this is the actual. So 4-5 methods are there. You can use the shortcut method to write an exam. You'll get marks, but you should be remembering the formula correctly. Okay. So duration we calculated. YTM is already done. Let volatility we have calculated. Let's go for convexity. So just for our reference, let me write the so here we will take it as X. We have written, or you would have written. Let me just write it as well. And TCF is our weight, and weight is the product is W into X. Okay. So now what we require, what is the formula we have written? The formula as such you don't worry, but heading you can remember it. So what is the formula written based on that heading? Numerator part was weight X multiplied by X plus 1. So how do we calculate here? The first one will be weight is 131, X is 1 into 1 plus 1. So it will be 131 into 1 into 2. How much that comes to? 262. So next one will be 115 is W into 2X, 115 into 2, then into 3, 2 plus 1, that is X plus 1. 690. Okay. Similarly, tell me others. Next will be 101 into 3 into 4. 101 into 3 into 4. 1 2. Okay, 1 2 1 2 fine. Then 88 into 4 into 5. 1760. Then 591 into 5 into 6. So this will be a big number. 7730. Okay. Total. $654. Okay. So convexity. Let's read the formula once. Okay, numerator we just calculated 21 654. Denominator we need to calculate. Sum of weights nothing but market price. That is 1026. That number, okay, or 1024.86. You can do that also. Multiplied by 1 plus YTM whole square means into 1.1424 square. $16.17. Okay, so this is for convexity C. Again a repetition what we just discussed or what we discussed in the conceptually part. This curve is represented by C, and this line, if you force fit a line, it looks like a line, that is force fitted by this volatility. So when you're trying to understand the movements, volatility is approximate measure and convexity is a more closer measure. Remember that convexity cannot be used directly, it has to be converted into convexity adjustment that should be applied on volatility. So next step is, they have not asked this in the problem, we are computing for our extra benefit. Again, convexity adjustment and all I have never seen so far, at least in the examination question, recent parts at least. So convexity adjustment, what is that formula? Convexity adjustment, half into C into change in YTM whole square multiplied by 100. 100 is so that it is expressed in percentage, that's the only purpose. So in this case, half is fine. C is 16.17. Change in YTM. Okay, change in YTM means how much percentage you are looking at. They have not asked in the question. We just want to understand. I just want to understand what will be the impact, let's say 1% change. You can do anything depending on what the requirement. For understanding, for illustration purpose, I'll go for 1% change. So I'll do 0.01 whole square into 100. Just 1% change. 1% change means 100 basis points. 1 by 2 into 16.17 into 0.01 square into 100. 0.0808. Okay, 0.0809. We can say 0.08 also. Let's say, okay, well, let's say 0.08. After all these are adjustments only, rounded off numbers. Okay, 0.08%. Because we multiplied by 100, remember, it's not just 0.08, it is 0.08%. So what does this convexity adjustment means? So if you want to know the actual movement, then volatility plus or minus this number is what you need to apply. That is what is estimated purpose. We'll apply now. So if you use only 3.388, that means in the graph, this line is what you estimate. If you estimate using that. But if you want to use the point on the curve, you need to go for this convexity adjustment. So the gap between the curve and the line is obtained by convexity adjustment. Write on that note line. When YTM changes, the market price can be estimated using volatility. Using volatility. In that case, next sentence, in that case, estimated market price would be on the line, within brackets, linear relationship. Next sentence, to compute the market price on the curve, volatility should be adjusted by convexity adjustment. Within brackets, non-linear relationship. Let's apply for this problem. Just a illustration. If YTM increases by 1%, if YTM increases by 1%, if YTM is increasing by 1%, what should happen? What is our estimation using volatility? Let's use it. Let's do it. Applying volatility, market price should reduce. Hope you understand why it is that. The inverse relationship. Market price should reduce by 3.388%. On 3.388% on what? Market price reduced by 3.388%, but on what number? 3.38% of what? Market price changes. Means from the existing market price. The existing market price is 1025.86. The existing market price changing. Existing market price is 1025.86 on that 3.388%. YTM is increasing by 1%. So what is happening to market price? You are trying to understand the change. So YTM 14.24 becomes 15.24. So 1025.26 should become what? That is the impact we are trying to analyze. So just multiply that, how much you get? 3.388%. $34.76. It should reduce by 34.76. Okay. So what will be the new price? Should be new market price should be 1025.86 minus 34.76. 991.1. Okay. $991.10. Okay. Now this is applying volatility. So what else we can do now, or what is we understood? When we applied volatility, we get the point on the line. But if you want more accurate answer, you should look at point on the graph, that is on the line, that is curve. And curve is obtained by one more adjustment, that is convexity adjustment. So let's do that. Same thing, but applying not just volatility, but volatility and convexity adjustment. Volatility and convexity adjustment. So how much should be? Convexity adjustment means we did 0.08. So that should be further added to 3.388. Now the question is, should I do plus 0.08 or should I do minus 0.08? In general, that is minus number. That is minus number because it's moving in opposite direction. But here, what should I do with respect to impact of increasing of ATM by 1%? So 0.08 is what we understood. Now 0.08 for this number 3.388, should I do plus 0.08 or should I do minus 0.08? That depends on the relationship again. What is the thing you are looking for now? YTM increasing by 1%. That means the impact, the relationship impact will be, it will be reduced by 3.388 and 0.08. So it will be 3.388, 0.08. Both are reduced. So you should be doing not plus, but you should be doing minus, because it is reducing. If it was increasing, then 3.388 plus 0.08. The relationship what you told, inverse relationship, should be applied here also. Because it is increasing in the market price, YTM will be reducing. 3.38 will be reducing. So here you can do 3.388 minus 0.08. That minus or plus is very important here. Otherwise you will deviate further. That is 3 point, how much you get? 3.3. Okay, 3.3. Again, 3.3% on 1025.86. Instead of 3.388, we are applying 3.3%. That adjustment so that we get the answer on the curve instead of line. What is that number comes to? 3.3% on 1025.86. 38. 3.3%, no? 33.85. 33.85. Okay. So new market price. The 1025.86 minus 33.85. 992. Okay, so the number is close. Okay, so this is using volatility, and convexity adjustment. We can always calculate using actual YTM also, because if you look at the table once more, the column W, the DCF column, giving you market price means discounting you use at YTM. When you discount at YTM, what you get the present value is market price. That is actually the perfect answer whenever you want to calculate. Let's do that. That also let's do it. So we can have the regular column like year. I'll just do it here. I have some space here. Like year, cash flow, discounting factor at new rate 15.24% and discounted cash flow. Year 1 to 5, cash flow 150, then year 5, 1000, discounting factor at 1.1424%. That is the new YTM, 14.24 plus 1%. How much you get? Annuity factor, I think 3 point something. $3.332. And last year 1000 and redemption price. See, do we get approximately? $992. Yeah, so this is what we are getting the answer closed, not closed, almost same as on the graph. So this 992 what we got is what is on the curve, and that is what we got it here, 992. But this also is close. 991 is also close. So in the exam, if they ask you YTM changes, you can calculate using 3 methods. One using volatility, which is approximate answer. The other using convexity adjustment, a more accurate answer. Or you can do using the YTM directly. All the 3 methods are valid. Unless they specify, you can follow any of the 3 methods, you will get full marks. So method 1 using volatility, methods 2 using convexity, and method 3 using YTM. Just to repeat the process of what we calculate so far. First we calculate intrinsic value, then we went to YTM, and then duration, and then volatility, and then convexity. You can say like 5 measures. But this one problem has everything. Of course, intrinsic value not done, but everything is there in this one problem. And shortcut also we applied. They are your additional benefits. Okay. Suppose if YTM reduces by 1%, what and all is going to do? If reduced by 1%, how you can estimate? This will be same only. But what is the change here using volatility? 1025.86 plus 34.76, because when it is reduces, the market price will increase. What is the change you do in convexity? 0.08 also you are going to do plus, same logic. This number will be different now, even though 1%, but this number will be different, and you are going to increase the new market price you will be obtaining. Or if you are using this tabular method, that will be 13.24%. 14.24 reducing by 1% means it becomes 13.24. And you can verify all the three ultimately should be approximately equal. And again, not to forget the basics. What is that basics? What is the coupon rate you have? In this case, 15%. What was the YTM given in the problem? 14.24. So YTM is less than coupon. When you get less, you are ready to pay more. More than face value, more than 1000, more than 1025.86. When this new percentage became, it became 15.24%. 15.24 means the YTM is more than coupon. More than coupon means you want more, and you want more means you will pay less. That is why it is less than 1000 rupees. So everything you learn should be applied on a cumulative basis. Do not leave out the previous one. We are not writing in sentences, but keep it in mind. Okay, so this is one full-fledged problem, covers all possible aspects. We just have to go for some more questions to get more practice. Okay, is this the next question you have? The following data are available for a bond: face value, coupon rate, years to maturity, redemption value, yield to maturity. What is the current market price, duration, volatility? Compute the market price if YTM increased by 20 BP, that is 20 basis points. Okay, first to compute market price. How do you compute market price? Market price nothing but present value. Present value, use intrinsic value, present value is market price. Only thing what changes is the discounting rate. And they have given the YTM. So present value of your coupon multiplied by annuity factor, redemption price multiplied by discounting factor. The total will give you the present value. That present value itself is market price. Now to compute market price, do you think we need to use discounting factor, or can we do with annuity factor also? I mean, when you write this year cash flow, should you write year 1 to 5, or can we write 1, 2, 3, 4, 5? Which is better here? You want to calculate one by one, or you want to calculate together like 1 to 5? You can do market price using 1 to 5, but the moment you come to duration volatility, that annuity factor concept don't apply unless you want to use the shortcut method. If you use the shortcut method, the table anyway we are not going to do. Therefore, my suggestion, let us go with the tabular format, which is more comfortable. So to compute the market price also, to compute duration also, Volatility also, in all the three cases, let's go with the tabular format. So please try. Year, cash flow, discounting factor at 9%. You can take 4 decimal points. Please compute and tell me what do you get. Present value 1116. Okay. 1117 approximately market price. First we'll get the duration volatility. For this problem, let's compute convexity also, only for this problem. Going forward, we'll not touch the convexity because it's examination wise, it's not very repetitive. So two problems we are touched, sufficient. So we'll do this also similar to the previous problem. We'll compute duration, volatility. For YTM shortcut not required. That if you have time you can do it later, but for the verification of that new market price, impact of change in YTM, that we'll do using convexity also, only for this problem. First you get the duration and get the volatility. First duration, do the products. 4.09, 3.75. Okay, let's have the one more column what we had, that is for convexity adjustment, W into X plus 1. So how much you get for the first one? 220.18. Second one, 606. Okay, 0.00 or 0.01 or something. Then 1011.92. Then 1700 point 0. Okay. 21,840. Is it exactly 840 or some? Two one 837 something 836.7. Okay. Total 25457.2. Okay, convexity 25457.2 divided by 1116.5.09 square. Just tell me how much you get convexity. Four seven five. Okay, so what is the convexity coming to? $19.19. 19.19. Or 19.20. Just round it off. 20. Okay. So convexity adjustment. by 2 into 19.2 into, again let's say 1% only, 0.01 square, 0.096. Okay, so next they're asking if YTM increases by 20 basis points. That's what they've given, right? Is not there that line? Okay, just add that line. As YTM increased by 20 basis points, that's all. Compute market price if YTM increases by 20 basis points. BP, you can just mention BP, 20 basis points. That is 0.2%, because you should divide by 100. To convert BP into percentage, 100 should be divided. Applying volatility, market price should be reduced by 3.75 into 0.20. So how much to take? Okay, one more thing, because it's asked for 20 base points, even change in YTM you better take that only, because later again doing it one more calculation is additional work. Instead of taking 0.01% change in YTM, because that is what we are going to make use of as the convexity adjustment. Convexity is fine, but for convexity adjustment we don't want 0.01, we are looking at 0.2% change, so that will be 0.002. 0.00384. Okay. Okay, so market price should be reduced by 3.75 into 0.2, 0.75%. And so market price should reduce by 0.75% on 1116.65. That is 8.37. Therefore, new market price 1116.65 minus 8.37. Double 108.28. Okay, let's do it using convexity adjustment. So MP should be reduced by, we got 3.75, but we don't take 3.75. 3.75 minus the 0.75 we had got, 0.75 minus this adjustment, which is minus 0.0038. Okay. 0.7462 percentage. So 0.7462% on 1116.65 equals 8.33. So new market price 1116.65 minus 8.33. Okay. Okay, let's do it one more method. What we did, like year, the cash flow using YTM method, using YTM. So what the discounting factor is going to be? 9.2%. So you get 1108.35. Check it. And you can see this 1108.35 is more closer. So this 1108.3235 is more closer. But in the exam, even if you do it using this, that is also accepted. Okay. 7:40 now. Take a break of 10 minutes. 7:50 we'll meet. 10 minutes.
Okay, hope you got this question. Mr. A will need rupees 1 lakh after 2 years, for which he wants to make one time necessary investment now. He has a choice of two types of bonds. Details are as below: face value, coupon, years to maturity, current price, current yield. Advise whether Mr. A should invest all his money in one type of bond, or he should buy both the bonds, and if so, in which quantity. Assume that there will not be any call risk or default risk. Let me quickly tell you what is call risk. Call risk means you are investing in the bond for, let's say, for a period of 4 years. If they redeemed in advance, if they do a premature redemption, like pre-payment in your housing loan, pre-closure, then your planning will be diluted, right? That is what is call risk. And default risk means what if they don't make the payment on time? We are assuming those two things are not there. In fact, in any problem, we'll assume these two are not there. So he requires rupees 1 lakh after 2 years. One simple suggestion what we can give him: you want 1 lakh after 2 years, today itself you save somewhere 1 lakh. After 2 years you will have 1 lakh. No, this is not the advice you should give. This is like telling, if one of your relatives ask you how to reduce income tax, right? Whenever you say you are working in CA office or you are CA, this one of the common question you get, that is, uh, you are a CA, very good, how to reduce income tax? Initially, I used to tell, do this, do investment, do show this exemption, HRA. Somehow they are not satisfied. Then I came up with one good answer. From that point onwards, they have stopped asking me for advice. So whenever they ask how to reduce income tax, I will tell, reduce your income. If you want to reduce income tax, reduce your income. No. So like that, we can't give advice for clients, of course. Similarly here, when you want 1 lakh after 2 years, we have to give some good process, financial management technique where you'll invest less than 1 lakh. You need 1 lakh after 2 years, so don't tell you save somewhere 1 lakh today itself. Maybe you save 90,000, 80,000, remaining you can generate through investment income. Now here we are looking at two alternatives: bond X, bond Y. Bond X is having maturity of 1 year, bond Y is having maturity of 4 years. But we need the money after 2 years. So bond X also will not help us, because after 1 year only it will get matured. And bond Y will take 4 years to mature. So in that case, how do you manage your interest risk? We call this concept as bond immunization. It means whether the interest rate in the market increase or decrease, whether YTM increase or decrease, after 2 years, we should be able to achieve at least 1 lakh. That should be our strategy. And we call that as bond immunization. And how do we achieve bond immunization? We achieve bond immunization, invest in both the bonds. One lower duration bond, higher duration bond. And when you invest in both the bonds, the weighted average of that should be equal to the holding period, target holding period. So by investing it, what will happen? I'm going to show it to you. But they have not asked. They just asked how much should you invest in both the bonds? If so, in which quantity? That's what they just asked. So let's calculate that. So you can just write investment should be made in both the bonds. That is one lower, one higher. Lower, comma, higher. One lower, one higher. Investment should be made in both the bonds in such a way that the weighted average of duration, weighted average of duration equals to holding period. Equals to holding period. So first of all, we should get duration then. Let's calculate duration of the two bonds, and that is why it is also called duration as optimum holding period. If you hold till that time, your risk moment will be less. Beyond this time, after this time, the risk moment will be higher. Interest rate risk will be higher. Anyway, first let's calculate duration of bond X. Then we'll go for duration of bond Y. Format you know, year, cash flow, discounting factor, discount cash flow. We don't stop with that. Year is like X column. Discounted cash flow is like weights column. For duration, we need a product X into W. So year, cash flow, discounting factor, discount cash flow, product. That is year is X column, DCF is W column, product is XW column. Now bond X only has 1 year duration, 1 year maturity. So redemption price 1000 equal to par value, and you get coupon first year and only 1 year 70,000 plus 70, 1070. YTM 10%. So discounting factor 10%. Multiply, you get DCF, and DCF into year 972 into 1, you get 972 itself. So duration is product 972 summation XW. Summation weights is also 972. You get 1 year. And obviously it is 1 year because it is an average holding period. Only one cash flow is there. Average comes to that only. Right? Even I told you the concept of zero coupon bond. The duration of the bond will be equal to maturity period because only one cash flow is there. So duration of bond X even need not be calculated. Simply you can take it as 1 year. For bond Y, we have to calculate. Year, we have to do it separately, and 4 years. Year 1, 2, 3, 4. Coupon 8%. On 1000, 8%. 80. So 80, 80, 80 last year along with redemption price. That is 80 plus 1000, 1080. Discounting factor, they have given multiply. Can you try and tell me how much duration you get? This is year is X column, DCF, that is weight column, product X into W column. And duration summation XW by summation W. Duration summation XW by summation W. Okay, hope it is done. See how much you get duration. Okay, so I think your calculator may not be working. I'll give the answer. 80 into 0.909, 72.72, 80 into 0.826, 66.08, 80 into 0.751, 60.08, 1080 into 0.683, 737. That's what is the market price comes to. Then the products, that is year column multiplied by TCF X into W, 1 into 72.72, 72.72, 2 into 66.08, 132.16, 3 into 60.08, 180.24, 4 into 737.64, 2950, and total 3335. Duration, summation XW, it is product total 3335.68 by summation W, nothing but market price, that is 6.52, you get 3.562 years. So duration of the bonds. So we have got duration of bond X and we have got duration of bond Y. Now we should invest in both the bonds such a way that their weighted average should be equal to the target periods. Let's assume the investment in bond X as X, invest in bond Y will be remaining proportionate. Okay, if I invest 30% in bond X, bond Y will be remaining 70%. So X in bond X, 1 minus X will be bond Y. So how do I do the weighted average? Bond X and bond Y. Bond X I am investing X and its duration, that is 1 year, and bond Y 1 minus X, its duration 3.562 years. You understand? Weighted average, summation X into W. So bond X into bond Y, I mean bond X plus bond Y. Investment in bond X is X into the duration is 1, investment in bond Y is 1 minus X, its duration is 3.562 and both of them put together should be your investment holding period of 2 years. So 1 into X plus 3.562 into 1 minus X should be 2 years. Let's simplify. 1 into X is X itself. 3.562 into 1, 3.562. 3.562 into X, 3.562X equal to 2. Let's keep the X together and numbers together. So 3.562X, I keep it as it is. This 3.562, I take it to right side, plus becomes minus. And this is X minus 3.562, 1 minus 3.562, minus 2.562. And 2 minus 3.562 means minus 1.562. Then X is minus 1.562 by minus 2.562, minus minus gets cancelled. You get 0.61 or 61%. So basically means 61% of my investment should be made in bond X. 39% of the investment should be made in bond Y, remaining basically. So calculate that. Okay. Now, since we have concluded here, 61% of the amount should go to bond X and remaining 39%, on what amount we should apply this? Should I say 1 lakh? 61% I should invest in bond Y, bond X, and remaining 39,000 in bond Y? No. 1 lakh is not the amount on today value. 1 lakh is the amount required after 2 years. So today itself you require means you need to do a present value of that. 1 lakh you require, take the present value of 1 lakh, whatever is the present value you get, that you divide 61% to bond X, remaining to bond Y. So let's calculate the present value of that. So amount required is 1 lakh, present value of the amount required. You can do discounting factor of 2 years, amount required after 2 years, discounted YTM, or you can do divide by 1 plus R to the power of n. 1 lakh is the amount required after 2 years. What is its value today? Present value, discounted YTM. Present value is 82,645. That amount should be divided in the proportion of 61% and 39%. So in bond X, 61% of 82,641 is 50,413 and remaining will go to bond Y. Or we can also write like this, maybe after 2 years it is 1 lakh. Today value or present value is 1 lakh divided by 1 plus 0.1 to the power of 2 years, that is 82,645. Or let me just calculate discounting factor. Have the given discounting factor we have used. Okay. For secondary discounting factor 0.826. 0.826, right? So I'll just do that. 1 lakh into second year discounting factor 0.826. That is 82,600. Or you can take more decimals. You get 82,645. That's also fine. So this 82,600 will be divided into bond X 61% and bond Y 39%. 50,000 rupees, 50,000, 386 rupees, 52,000, 32,214. This is the amount to be invested. Amount to be invested. Okay, this is the amount to be invested. But have they asked in the problem how much amount to be invested? The requirement of the problem is in which quantity. Quantity means number of units. So you divide by the market price of the respective bonds will give you the number of units. That's what is quantity to be purchased, number of units. So what is the market price? For bond A, it is divided by 972.73 and divide by 936.52. 50,386 by 972.73, you get 51.79. But I'll round off 52 units. And here 34.39 or 34 bonds. So this is what they've asked in the problem. We have to do more interpretation, but you complete this part. We have just done what is required in the problem. Then I'll go for the interpretation part of it. So what they've asked, in which proportion, how much quantity should be invested in two bonds? And what process we have followed? We have calculated duration of X, duration of Y, then the weighted average duration should be equal to the holding period. And we have calculated the proportion. We have calculated the present value of the amount required, present value of 1 lakh, and divide the amount what we calculated in the proportion what we calculated and divide by the market price. You will get the number of units or the quantity they have asked. If they just asked in which proportion to be invested, our problem will be stopped at 61% and 39%. If they ask how much amount to be invested, then I will be telling 50,386 and 3224. And if they ask, like in this case, quantity, I will divide by the market price. That will give me number of units. Okay. Now, regarding the interpretation part, I am going step next, not asking problem, only for our understanding. What is this bond immunization? We have invested in bond X and bond Y, one lower period, one higher period, and the target of doing that is, if the YTM increase, we are protected. If the YTM decrease, we are protected. How is that? Okay, first of all, I'll tell you. I invest in bond X. That will be matured after 1 year. Maturity period is 1 year. No problem. The second bond X, is having maturity period of 4 years. You have invested 34 bonds there, and you have that's going to be matured after 4 years. You need the money after 2 years. What do you think you are going to do? Are you getting my question? I need the money after 2 years, but the bond will be matured after 4 years. There is a time gap. How we can fill the time gap? No need to fill the time gap. That is the advantage of bonds. What is that? We will have bond markets. The bond Y having maturity of 4 years, you don't have to wait till 4 years. After 2 years only, you can sell in the market and you can get the money. You don't have to wait till the end. Now, what is the concept of YTM, yield to maturity? You remain invested till the end, but if you sell in between, we don't know how much we get. Market rate can fluctuate. But what we are telling, immunization, whether YTM increase or YTM decrease, your 1 lakh is protected. Assuming, of course, no call risk, no default risk. If you are only talking about interest rate risk, we are immune, we are protected. How it is going to be protected, I'll explain you conceptually, then numerically. Again, not required for exam, only for our discussion purpose. Okay, so how immunization, bond immunization is achieved? How immunization is achieved? Okay, so let me discuss in two situations. One, YTM increase, another YTM decrease. We are discussing two scenarios. If YTM increase, what will happen to your investment position? If YTM decrease, what will happen to your investment position? Okay, let me talk about bond X first. Now, bond X is having maturity of 1 year, but you need the money after 2 years. So 1 year, the bond gets matured. Will you keep it idle? No. After bond X gets matured, you will not keep it idle. You will reinvest. Assuming you are having, you will reinvest in bond Y only, let's say. Because bond Y still is trading at market, right? We call that reinvestment, because 1 year time period is there. You don't keep the money idle, it will become waste, you lose opportunity cost. So bond X, after year 1, you will get matured and you will reinvest. Okay, now if YTM decreased, if YTM, sorry, we are looking at YTM increased. If YTM increased, what would have happened to bond X? I mean, bond X will not have any impact, right? Because 1 year only will get matured, market price don't matter, redemption price is already fixed. So YTM increase will not have affect any bond X, but the maturity of bond X will be reinvested in bond Y. Now, when YTM increase, what will happen to bond Y? When YTM increase, you can reinvest at a higher number of units, right? Because market price reduces. YTM increase, market price reduce, you can purchase more number of units. So you have reinvestment, or I'll say it's a bond X, bond Y. I'll say what is your gain and what is your loss. Okay, gain is you can reinvest higher number of units. You can reinvest higher number of units because price reduces. When price reduces, you can purchase more number of units after year one. Reinvest higher number of units. But what is the loss? The existing value what you have, existing price, you already invest in bond Y, that price will come down. So existing investment will reduce. If YTM decreases, opposite happens. If YTM decreases, price increase, and price increase means you will not get more number of units, so you will have reinvestment at a lesser number of units. Means coupon will be less. But when YTM decreases, price will increase, so existing investment value will increase. Existing investment value will increase. Okay, this is theoretical, conceptual. What exactly happens? I will show it to you. In two scenarios, I will show it to you. I hope you have taken this down. Again, I repeat, this is not required for exam. I seriously doubt if they ask these things in exam. The purpose of these things is to demonstrate the application side of it. Just for understanding, nothing beyond that. Okay, I'll take it out. If YTM increase, I'll discuss that situation. If YTM increase to what is the present YTM? 10%. Let's say YTM increases to 11%. What are the series of things you are going to do? You are investing in two bonds. Let's say you are having bond X and you are having bond Y. And today you have invested something, and after year one, what happened? After year two, what happens? In bond X, you have invested how many units? Approximately 52 units. And in bond Y, you invested 35 units, 34 units. You can say 35 also. I'll say 35 units, 34.4. Or okay, 34 units. Let's say 34 units. You have invested 34 units. Now, year one, what happens? In bond X, this will mature, right? This will mature. And bond Y, in year one, what happens? Any event happens in year one relating to bond Y. It will happen what? You receive coupon. Coupon you receive. Okay. Let's see how much amounts. It will mature at how much? How much amount you receive? 52 units. And what is the cash flow? 1000 cash flow per bond, 1070, right? So 1070 into 52 will receive. Is it correct? Coupon also will receive, cash flow also receive. So 52 into 1000. 52 into 1070. 1000 plus 70, right? 1070. 52 into 1070. 55,640. You will receive 55,640. And how much coupon you receive here? 34 units multiplied by what is the coupon of bond Y? 80 rupees. 34 into 80 rupees. 2720. So how much money you will have at the end of year one with you? 57,640 and 2720. Now these two amounts, will you keep it with yourself in cash? That will be idle amount. So what you are going to do? You will be reinvesting. You will be reinvesting at what rates? Or reinvesting in which bond? You will be reinvesting in bond Y. So you need to know what is the market price of the bond Y at the end of year one. Market price of bond Y at the end of year one. That is after 1 year. At end of year one. How do we calculate? You can follow the format quickly. Year, cash flow, discounting factor, discounted cash flow. Year, how many years remaining now? 1 year over. Out of 4 years, 1 year is over, remaining 3 years. So 1 to 3 years, cash flow will be 80, and last year 3, cash flow will be 1000. Discounting factor at the rate of 11%, changed to 11%. Discounting factor at 11%. So 11% for 3 years, 2.4437, and 11% for 3 years, 0.73119, 0.7312. So 80 into 0.24437, 195.5. 1000 into 0.7312, 731.2. You get 926.7. So you will have now 926.7. And as you can see, the bond price would have been reduced. I mean, when the YTM increases, bond price will reduce. But anyway. So what is the reason why we calculated this number? After year one, from bond X, you received some amount in the form of maturity and coupon. Bond Y, you received coupon. Now, both these amounts, you don't keep it with yourself, you are going to reinvest. So, how much you are going to reinvest and how many units you will get. So, this is going to be reinvested. So, totally you will have 55,640 plus 2720, 58,360 divided by 926.7. 62.97 units. I'll round it off, 63 units. Now, you're already having 34 units, right? Previously, you're having 34 units. Now, you received additionally 63 units. That is what is going to be matured on year 2. So, what will happen in year 2? Year bond X, nothing will happen because it's already matured, it's matter closed. Bond Y, you will have two types of cash flows. One is coupon, and the remaining units, or what a number of bond Y units you have, it will not be redeemed. It will be redeemed after 4th year, meaning 2 more years. But you are going to sell. So you receive coupon as well as you are going to sell. Sale value. Okay. How much is going to be coupon you receive? You receive coupon on how many units? Not on 34 units. You have 63 units also. So 34 units plus 63 units multiplied by 80 rupees, right? Coupon. So 34 plus 63 into 8. 7760. Okay. And what will be the sale value? Now, sale value, I cannot use 926.7. I have to recalculate. I have to recalculate in the sense, again, bond value at the end of year 2. So, uh, market price of bond Y at year 2. Again, same table. Year cash flow discounting factor at 11% discounted cash flow. Now, here we should look at remaining 2 years. Year 1 to 2. Cash flow is 80. Year 2. Cash flow is thousands. Or you can use a discounting factor. I think you can do, okay, let's follow the same format. Discounting factor at 2%, annuity factor 11% for 2 years, 1.7125, then 1 by 1.10 to the power of square, 8.8116. So 80 into 1.7125, 137,000 into 0.8116, 811.6. Total 948.6. Okay. So how many units you get? 34 plus 63 multiplied by this number, 948.6. This is the sale value. This is the market price after 2 years at which you are going to sell into 948.6. You get 92,040. So how much cash flow you have total? 7760 you will receive coupon plus 92,014 you receive 99,774. Anyway, that exactly is not equal to 1 lakh because of the round off issues. Because you are rounded off the units like 34.4, you round out to 34 units. Had I rounded out to 35 units, I would have got a little bit more than 1 lakh. But approximately, it's 1 lakh. 99,724. So approximately 1 lakh. Okay. This is what is if YTM increase to 11%. You can try the similar thing if YTM decrease from 10 to 9%. In that situation, what will happen? If YTM decrease to 9%, the market price will increase. So when market price increases, the sale value will be high because you can sell at a better price. Sale value will be high, but number of units what you receive will be less because market price is high. So one advantage of price and one disadvantage of quantity. Ultimately, that will also come to approximately 1 lakh. You can try that out later. But I hope you got the concept how this bond immunization mechanism works. So I have done for one. If YTM increase to 11%, you try similar process calculations where you have to make this 11% as 9%. This will be recalculated. This will be recalculated, and number of units will change, and the coupon value, sale value will change, but total will still be approximately be equal to 1 lakh. Hope you can try that. Okay, let's go further. Hope you got the question. The following is the yield structure of AAA rated debenture. Period 3 months 8.5, 6 months 9.25, 1 year 10.5, 2 years 11.25, 3 years and above 12. Based on expectation theory, calculate implicit 1 year forward rate in year 2 and year 3. First thing you please understand, yield, in percentage always means per annum basis. So do not think for 3 months I get 8.5%, how much for 1 year I get? No, it is 8.5% per annum. Now 1 year also 10.5% per annum. Everything is percentage on per annum basis. Okay. Now, before I look at the formula part, quickly let me tell you the approximate answer, addition model, only for understanding purpose. Then I will go for a multiplicative model with accurate formulas. Okay. If I invest for 1 year, how much return I get from investor point of view? If I invest for 1 year, I will get exactly 10.5%. 1 year, I get 10.5%. Okay. Now, let's say 10.5. If I invest for 2 years, how much do I get? Now, this 11.25, do you understand it is for second year? Or do you understand it is for both the years? I repeat the question. Listen to it carefully. 11.25 is for second year or 11.25 is for both the years. It is for both the years. Why? It is the word used yield. Yield is for all number of years, so it is both the years. If they use the word forward rate, FR, implicit rate, then it is only for second year. Yield is for 2 years. So 11.25 I get for first year also, 11.25 I'll get for second year also. So for 2 years, if I put it together, my total returns is 11.25 plus 11.25 22.5. Sir, you cannot add 11.25, 11.25 like that because compounding will be there. Understand? Hold your breath. I'm now telling you conceptually. So I'm using additive model. But to be more accurate, I will use multiplicative model, compounding effect, I'll come to it. But answer will be very, very close. It will be fractional difference, some points difference. So conceptually, for discussion purpose, I'm following additive model, but in the exam, you have to present multiplicative model. Okay. So what is the incremental year? So from 1 year, if I increase my holding period to 2 years, that is, I increase my investment period by 1 year. So what is my incremental return? If I invest for 1 year, I get 10.5. If I invest for 2 years, I'll get 22.5. So incremental return, can I say 12%? So indirectly, if I want 22.5 for second year at the end of 2 years, first year I'll get 10.5, second year alone how much I get on an incremental basis, I get 12. So that total comes to 22.5. Hope you understand this approach of incremental calculation. Incremental 1 year to 2 years, incremental 1 year. Return 10.5 becomes 22.5 cumulatively. So incrementally or attributable to second year is 12%. And that is what is the rate of interest applicable for second year. That's what they're asking. Implicit 1 year forward rate in year 2. You can say implicit rate, conceptually take it incremental rate. Similarly, if I increase from 2 years to 3 years, then what will happen? Understand, very simple. I'll apply the same logic. Now, if I make it as 3 years, how much cumulative returns I get? 3 years and above, it is 12%. 12%. 12% is not for 3 years, I mean, not for third year, 12% for year 1, year 2, year 3. So 12 plus 12 plus 12, it becomes 36. So up to 2 years, I will get 22.5. If I increase by 1 year, I will get 36. So for third year, what is the rate of interest attributable to third year? 36 minus 22.5, approximating 13.5. So this is the rate of interest attributable, incremental for third year, called as forward rates. This is the conceptual part. Now let's calculate using the formula, that is using the multiplicative model. Okay, now one more thing. If I ask you this, if third year, if I increase it to fourth year, what is my implicit rate, incremental rate? 4 years means how much I get? 12, 12, 12, 12, 48. So I get incremental of 12 only. Yes, sir, obviously. Why? Because third year and above, there is no incremental benefit. You just 12, 12, 12, 12 every month, every year. So there is no forward rate separate, there is no yield separate. So there is, if 2, 3 number comes, we take an average. If only one number is there, then average is also that number only, forward rate is also that number only. So keep it in mind, forward rate is for a particular year and yield is like an average for certain number of years. Let's calculate using the multiplicative formula. That is, everywhere I'll do 1 plus. So 1 plus forward rate of year 1 should be equal to 1 plus YTM. Therefore, first year, 1 1 also will get cancelled. So for first year, forward rate of year 1 will be equal to YTM of year 1. In this case, it is equal to 10.5%. So in fact, they don't even ask in the problem. They have asked only for second year and third year because first year in question only it is mentioned. So forward rate of year 1 means 0 to 1. Only 1 year, only 1 year average. Only single number. So average is also that number. Forward rate is also that number. Let's do second year. 1 plus forward rate of year 1 into 1 plus forward rate of year 2 is equal to 1 plus of YTM of year 2 whole square. Forward rate of year 1, we know it is 1 plus 10.5, so 0.105. Forward rate of year 2, we have to calculate 1 plus forward rate of year 2 equals into 1 plus YTM of year 2. YTM we know, year 2 YTM 11.25, so 0.1125 square. So 1 plus forward rate of year 2 equals 1.1025 square divided by 1.105, 11.25, sorry, 11.25. And in fact, this 1 goes to right side. So here only directly I can write minus 1. Minus 1, 0.12005 or forward rate of second year is 12.005%. You can write 12% also. The reason why I'm telling you 12.005 because even on our additive model we got 12% only, right? 22.5 minus 10 point we got 12% only. So you should not think that both are equal. For that, you to understand the difference I'm writing, in the exam you can write 12%, that is also fine. Small difference is there. As I told you, additive model, multiplicative model will be almost close. But in the exam, marks may not be close. So you have to present it using multiplicative model. So what's the interpretation of this? Let me write down. Forward rate of year 1. Okay, let me write interpretation a little later. Let me complete the third year also. Then I'll do interpretation. Okay, and one more shortcut also you can use if you want to use this. Forward rates, you can calculate this shortcut for verification purpose. Difference in rates divided by difference in number of years. Cumulative rates, okay. Now difference in N. So this we are doing second year minus first year. Second year minus first year. Now second year we are having 11.25. So 11.25 into 2 minus first year 10.5. So 10.5 into 1. Rewrite once more. 11.25 is for 2 years. So 11.25 into 1 minus 10.5 is for 1 year. So 11.25 is for 2 years. So into 2 by 10.5 is for 1 year. Whole divided by 2 year minus 1 year. So cumulative differential interest rate. Difference in rates by difference in N. You get same answer 12. That's what is additive model approximation. So use this as verification purpose. Use this for verification. Okay, now let me come to third year. I hope you have done till here. So third year means 1 plus FR1 into 1 plus FR2 into 1 plus FR3. 1 plus FR1, 1 plus FR2, 1 plus FR3 equals 1 plus YTM of year 3 whole cube. So forward rate, we move 1 year at a time and different numbers. YTM, average, straightforward, 1 plus YTM cube. So 1 plus forward rate of year 1, that is 10.5. So 1 plus 0.105. Second year forward rate, we calculated 12%. So 1 plus 0.12. Third year forward rate, I would like to calculate. And YTM of year 3, 12%. So 1 plus 0.12 whole cube. So forward rate of year 3, 1.12 cube divided by 1.105 into 1.12. Then this 1 plus FR3 plus 1 is there, goes to right side, it becomes minus 1. 1.12 into 1.12 into 1.12 by 1.105 by 1.12 minus 1. 0.1352 or FR3 is 13.52%. A little bit in calculator. Now when you're doing this, 1.12 cube, how to do in calculator? 1.12 into 1.12 into 1.12. Denominator, what you can do? Simply divide. Divide by 1.105, divide by 1.12. Then minus 1. So 1.12 into 1.12 into 1.12. Divide by 1.105, again divide by 1.12. You don't have to write somewhere. Keep dividing it. Then last minus 1. 0.135. Okay, one more thing you observe. If I look at final formula alone, that also we can create a formula. That is, forward rate of year 3 is calculated by 1.12 cube. That is YTM of year 3. No doubt. Denominator, what I am writing? 1 plus FR1, 1 plus FR2. And what is 1 plus FR1, FR2 means? 1 plus YTM square, right? So, I can write the formula also for forward rate directly. I will write that formula. First you write down till here. Okay, hope you are done till here. I'll take this part out. Okay, so forward rate of year 3, I can also directly calculate like this. 1 plus YTM of year 3 whole cube divided by 1 plus YTM of whole square minus 1. Let's see if I get the same answer. YTM of year 3, 12%. So 1 plus 0.12 whole cube divided by 1 plus YTM of year 2, 11.25. 1 plus 0.1125 whole square minus 1. So directly do in calculator 1.12 into 1.12 into 1.12. Keep dividing by 1.1125 by 1.1125 minus 1 into 100. You get same number 13.515, that is 13.52%. Logically, no. What is meaning of multiplication? That is compounding effect, isn't it? I do 1 plus r. I move by 1 year. I do 1 plus r. I move by second year. I do 1 plus r. I go to third year. Now I discount. Divide by 1 plus YTM. Second year discounting. Divide by 1 plus YTM. One more year discounting. So remaining 1 year pending. Are you understanding? I compound by 3 year, discount by 2 year, effectively 1 year remaining. That is what is third year. Anyway, this is a YTM of year 2. Or in general, can I say like this? Or what is the formula? A shortcut formula, verification. Forward rate of year 3. What is the shortcut I told you? Difference in rates divided by difference in number of years. Difference in rates. Let's say I'll use a third year, second year. Third year 12%. So 12% for 3 years. And 11.25 is for 2 years. 11.25 is for 2 years. Divide by third year minus second year. So 36 minus 22.5 divided by 1. I think you get 13.5. Approximately say. Or in general, the formula for forward rates can be written like this. Forward rate for year n, I can do 1 plus YTM of year n whole to the power of n, like 1 plus YTM of cube, year 3 whole cube, whole divided by, I take up to previous year, I discount up to previous year, that is 1 plus YTM of year n minus 1, 1 year less, whole to the power of n minus 1. And ultimately you can do minus 1, and you can see this is what is the difference between multiplicative model and additive model. Okay, just for curiosity's sake, if it is forward rate of 20th year, what will I do? 1 plus forward rate of 20th year to the power of 20 divided by 1 plus YTM of, this 1 plus YTM of year 20 to the power of 20, 1 plus YTM of, I do 1 year less, 19th year to the power of 19, then minus 1. Anyway, so this formula I had given you earlier, but I wanted to explain conceptual manner. I hope you have got it. But even if you don't know this formula also, it's fine. By conceptual method, the way you solve the problem, you can directly go ahead. Okay, hope you got it. One more way I would like to just summarize this concept of forward rate YTM. With that, I hope you get the absolute clarity. But make sure you have written down till here. Okay, hope you have done. Now, what and all we have got so far? Forward rate of year 1. How much we got? 10.5. Forward rate of year 2, we got 12. Forward rate of year 3, we got 13.52. This is what we got year 1, year 2, year 3 separately. Now, what is YTM? YTM is like average rate. So, considering only forward rate of year 1, this is YTM of year 1, which is equal 10.5. Now, when I come to forward rate of year 2, I will take forward rate of year 1 and the forward rate of year 2. Like first 2 year average, forward rate of year 1 and the forward rate of year 2. First year forward rate and second year forward rate. This is what is YTM of year 2, that is 11.25. Then forward rate of year 3 and forward rate of year 1 and forward rate of year 2, all the 3 years put together, if I take an average, that is what is YTM of year 3 is all about. So this is only using forward rate of year 1. This is using forward rate of year 1 and the forward rate of year 2. This using forward rate of year 1 and forward rate of year 2 and forward rate of year 3. That's how we get 12%. Hope this pictorial representation should make the concept more clear. Write down this also. Okay. I hope you have taken down till here. I'll go one step further, which will be required in our interest rate management chapter, which will come later. They have given this 3 months, 6 months. We have not used here because they have not asked. What if they have asked that also? That is, what is the forward rate for 3 months later, or what is the forward rate for 6 months later? How to calculate within a year? Let me tell you that. I'll take this part out. Hope you have taken it down. Okay. So what they have given is up to 3 months. What is up to 3 months? 0 to 3 months. 0 to 3 months, it is 8.5% percentage per annum. Okay. 8.5. Then 6 months, that is 0 to 6th month, is 9.25. So if I have a deposit for 3 months, I get 8.5. If I deposit for 6 months, I get 9.25. What is the rate applicable for 3 months to 6 months? Implicitly, indirectly, incremental basis, that is the forward rate from 3 month to 6 month. So if I write 6 months, what is this? So how are we going to write it? How are we going to calculate? So I'll write like this: 0 to 6 months is 9.25, right? 9.25 percentage. And this I'm going to break it down into 0 to 3 months and 3 months to 6 months. 0 to 3 months, we know it is 8.5%. 3 months to 6 months, you would like to calculate. In fact, people write like this: forward rate 3,6 means 3 months to 6 months, or after 3 months for 3 months. And we follow multiplicative model. Okay, how do we do multiplicative model? This is 1 plus 0.0925 for 6 months. So into 6 by 12. 6 months. Okay, that's why. Do only for this one. Okay, don't do plus 1, or I'll put the brackets correctly. This is first calculation, then you do this. Similarly, this is 1 plus 0.085 into 3 by 12 and close the brackets, and so multiply 1 plus this, I don't know, let's say let's say x or r something, into this also 3 by 12. 3 to 6 months means 3 by 12. Simplify. This is 0.0925 into 6 by 12, 0.04625. So 1.04625. This is 0.085 divided by 4 plus 1, 1.02125. And this is 1. 3 by 12 means 0.25 r. So 1 plus 0.25 r. Okay, this I'll take it left side. So this will come to denominator. So 1.04625 divided by 1.02125. So you get 1.02448 equals 0.1 plus 0.25 r. So 1 goes to right side, that becomes minus 1. So 0.02448 equals 0.25 r, or r is 0.02448 divided by 0.25 into 100, 9.79%, approximately I think 8%. Please see if the calculation is fine. And you can use the shortcut formula also. What is shortcut formula I told you for forward rates? Difference in rates by difference in number of months or number of years. What is difference in rates? 9.25. We used to multiply it by number of years, right? And what is number of year here? This is for 6 months. So 9.25 into 6 by 12, or I'll say 0.5, minus 8.5. This is for 3 months. 3 months means 3 by 12. So into 0.25. 8.5 into 0.25 whole divided by difference in years. So 0.5 years, 6 months minus 0.25. So 9.25 into 0.5, 4.625. 8.5 into 0.25, 2.125 divided by 0.25. You get 10. I told you this will be close but not accurate. 10%, 9.79%. So approximately you will be able to verify your answer. So I've done for 3 to 6 months. You can try similarly for 6 to 12 months. How do you write 0 to 12 and 0 to 6, 6 to 12? 0 to 12 given, 0 to 6 given, then you calculate 6 to 12. So write down. Let me know if you have any doubts. Okay, so hope you have taken down. This is the concept on forward rates and YTM. This will again come in interest rate management when we discuss later. Make sure you remember these concepts: forward rate, YTM. There, please don't give me shocking looks. Forward rate, YTM and all. We will be using these things, applying these things in our interest rate management chapter. So there, make sure you remember this. Did you get this question? Let us read. Trans India Limited is contemplating calling off 3 crores of 10 years rupees 1000 bond issued 5 years ago with a coupon rate of 14%. Okay. Now, can you tell me what is the remaining maturity of this bond? You had issued 10 years back. You have issued a bond with 10 years and it was issued 5 years ago. Now you are having a remaining life. Remaining life, okay, 10 minus 5, 5 years. Coupon rate of 14%. Bond will have a call price of 1015. Call price of 1015 means if you want to redeem it earlier, still 5 years maturity is there remaining. But if you want to redeem it earlier, you have to pay 1015. So you have to pay extra. Yes, that is called as call premium. 15 extra is there, no? That sometimes you should also call it as call premium. Like in a bank, if you repay housing loan, they will levy some penalty, right? Loan pre-closure charges. Like that. If you redeem the bond earlier than original maturity, you have to pay some extra amount as a compensation to the holders. That's called as call premium. In this case, it is 15 rupees or I think 1.5%. Had initially collected the proceeds of 2.191 crores due to discount of 30 per bond. Okay, 3 crores face value, but net proceeds long time back was only 2.91 crores because you had offered them discount on issue. Initial flotation cost was 3,60,000. The company intends to sell means intends to issue 3 crores of 12% interest rate, coupon rate, 5 years bond to raise the funds for retiring the old bonds. It proposes to whom? To sell the new bonds at a par value of 1000. Estimated flotation cost is rupees 2 lakh. The company is paying 40% tax. New bonds shall be issued 2 months before retiring the old bonds to avoid any market risk and using the proceeds from the new issue to retire the old bonds. What is the feasibility of refunding the bonds? Okay. So what is this problem is about? First point, this problem is from issuer point of view. Issuer point of view. And what decision they are trying to do? They are trying to make a decision of whether to redeem the old bond, redeem the old bonds, or replace the old bond. You can call both ways. Redeem the old and issue the new, or continue with the existing bond. Continue with the old bond. Don't touch new. Continue with olds. This is the decision they are trying to do. Why this decision is coming? Because when the issuer had issued 10 years back, interest in the market was high. So you are forced to pay that much coupon. Reality also same thing. Long time back, interest rate was higher. Now, for various factors, GST, demonetization, corona, whatever it is. Interest rates have fallen. But are you enjoying that benefit of lower interest rates? You are a issuer, you are a borrower, you have taken the money back, you have already entered into a commitment. Now, even though market interest rates are lower, you are not enjoying. So, what you're thinking, okay, let me repay the old bonds and issue the new bonds. So, I can issue the new bonds at the existing market rate, which is lower, so I can save interest. Same situations will come if you have taken housing loan. Think from individual point of view. Had you taken the loan 5 years back, your housing loan interest would have been like 9% to 10%. And now over the housing loan, maybe 6%, 6.5%. But had you taken a fixed rate housing loan, you don't get any benefit because you have taken already 5 years back and you already committed for a higher interest rate. So, what is the choice available for you? Being a borrower, you said transfer of loan, balance transfer. Old loan you repay and you take a fresh loan. Since fresh loan will be at a lower rate, you can save interest. But it will have some expenses also, like pre-closure charges, transfer charges, issue charges. So, a lot of cost benefit analysis we have to do. And that is what this problem is all about. We have two choices available in front of us. Compare the two choice, cost benefit analysis, and see whether the benefit is positive. And in this process, I'm going to follow three approach. It's called as initial approach, initial cash flow, interim cash flow, terminal cash flow. Whenever these big problems comes in bond valuation chapter, in capital budgeting chapter, like that, follow this approach. IIT, initial, interim, terminal. When you take a decision, what is the impact? Initial, like in purchase of machinery, purchase price, immediate impact. Interim cash flow, the second word I've written, interim cash flow. When the project is alive, what is the cash flows? Like if you purchase a machinery, when the machinery is alive, you will have depreciation, you produce units, you get profits, you get cash flow. Interim cash flow. And terminal cash flow means what comes at the maturity, when the life is over. When the machinery life is over, you get scrap value. So any big problems in financial management, if you have to calculate NPV, then keep these three things in mind. Initial cash flow at the beginning, terminal cash flow when the project is alive, interim cash flow when the project is alive, and terminal cash flow when the project is completed. But we are doing a replacement problem. So replacement problem means there will be some initial cash flow in the first alternative and second alternative. So I'll calculate both and compute the incremental cash flow. Interim also, the decision 1 will give you some cash flows. Decision 2 will give me some cash flows, and I am going to do the interim cash flows. Terminal cash flow also, the one decision will give me one cash flow, one more decision will give you one more cash flow, and I'm going to calculate the incremental cash flows. Difference between these two decisions, what is additional cash flows I get or I pay under these three categories. Then I do the total. And due to the total, I simply don't add. Why? Because time value of money. Initial cash flow, no problem. I can multiply it by 1 because today value, present value. Interim cash flow, if every year cash flow is same, I can multiply it by annuity factor. If every year cash flow is same, to convert this into present value. If every year cash flow is not same, then I'll have to prepare a table or format. I need a discounting factor. And terminal cash flow, I have to use discounting factor because this comes only once. And adding all these things, what I get is NPV. If NPV is positive, decision to be accepted means you go for the decision of replacing. If NPV is negative, then don't go for the decision. Existing bonds only is better option. First of all, did you get the overall picture of this problem? Why this situation arises and how to handle this on a generic level. Solving problem is a matter of few minutes. Getting the structure and the reason why this problem is coming, you need to understand. So if you have not written it, please write down this approach. This you don't have to write in exam. This is for you to have a logical thinking. In a framework you have to solve. This is the framework. In SFM, there is two simple approach for you to score well in exam. Two simple approach. When you read systematically, understand systematically, logically, and when you write in the exam, present your answer systematically. How do you present your answer systematically? In a as much as possible simple tabular format. More logical tabular format you present, more easy for you to get the marks. Unless you are very thorough in the topic, you will not be able to present in a tabular manner. So proper presentation, proper understanding. Two simple aspects. Think structurally, systematically. Why this problem comes? How do we solve this? What is our conclusion? In law also, audit also, what is facts of the case? What is that law position? Statute says conclusion. Always that is the thing. Even in any difficult issue comes in your life, think in simple systematic way. What is the problem? Analyze what is the solution. That's all. I think for me, in my opinion, understanding mathematics will help you think in the systematic manner. Many people don't like maths. People do also ask this question, where does a plus b whole square in real life? Who will learn mathematics? The reason why people don't like mathematics is because people don't like problems. They want only solutions. But in mathematics, only problems is there. Solution you have to find out. So people don't like mathematics. In life also, so many problems do come. Solution is what you have to find out. But we are not used to that approach. At least we don't read mathematics from that mindset. Or mathematics, SFM, whichever subject it is. Always have a solution oriented mindset. Things becomes much easier. Rather than complaining, this is not good, that is not right, these people are bad, I don't like them. Rather than that, try to think what I can do, what can be done, what should be done. Instead of focusing on problems, try to think what can be done to get the solution. In fact, mathematics teaches you that. I may be slightly out of the topic, little bit of philosophy in mathematics. In mathematics, every question has a solution. It's just that you don't know the solution. Solution is there. Every problem in your life has a solution. It's just that we don't know what is the solution. Anyway, so let's come back. I know that it might not be very comfortable for some people in the morning sessions, but you can't avoid. That is, I believe, as my responsibility, not just to tell what the subject is. In my opinion, you should also know how to use the subject outside. I'm not going outside the subject, but try to make use of it, is all what I wanted to say. Okay, so let's go further. So we have discussed this overall approach we have discussed. Let's go for simpler structural tabular format. So let me go for first initial cash flow. The thing is, institute does not give this much of structural presentation. They give one table, answer is given. So some people may not understand it. So I'm trying to show you as detailed the calculation as possible. So initial cash flows, then that is two column I'll write. One is you go with the old bond, you replace with new, means don't redeem, redeem, that's the meaning. And then we are going to have incremental approach. Okay, now what are the cash flows that are coming in? Let's do one by one. You have to redeem the old bond, so redemption of old bond. Okay, if you continue with the old bond, okay, let me write continue with the old bond, that's a better heading. Continue with the old bond. Will this transaction of redemption of old bond comes or not? The redemption of old bonds and issue of new bonds comes only in the second alternative. If you continue, nothing will come. So I'll say 0. In fact, all my cash flows in initial cash flow in continue the old bond is 0, because if I continue, I don't have to do anything today. Every year I have to pay interest, but today I don't have to pay anything. So 0. Replace with the new bonds. Replace with the new bond, redemption I have to do. How much redemption I have to do? Face value. I'll just take face value redemption. Then I'll take the premium element. Face value 3 crores. Okay, this is 3 crores, 3,60,000. Okay, I'll take full amount 3 crores. Face value 3 crores. Okay, 7 zeros, 3 crores. Now incremental I will not write it now. I'll write only at the end. Total amount is sufficient. One by one I don't have to do incremental. So I can complete this table, then I'll do incremental. Redemption of old bond. This is outflow. So I'll show within brackets. Outflow means within the brackets. And redemption is not happening at face value. Redemption is happening at premium. Call premium, I will say. Call premium. Premium or redemption. Early redemption. Call premium. Outflow. Continue with old bond 0. And this is the premium portion. How much premium I have to pay? 15 rupees. 1015. So 15 rupees is the extra amount. So 3 crores divided by 1000 rupees into 15. 3 crores by 1000 rupees into 15. 4,50,000. This is also outflow. 4,50,000 is also outflow. Now, call premium is an expense. When you have an expense, you should also consider its tax impact. When you have an expense, tax payment will reduce. In other words, we get tax benefit. People say like tax shield, we get tax benefit. How much it is? Any tax rate company is paying 40% tax. Now, as per Income Tax Act, is this call premium allowed for income tax purpose or not? I don't know the answer. And you need not know the answer, because we cannot solve the problem only from Indian income tax point of view. SFM is a universal subject. That's why I told you this subject is not bound by legal boundaries. You can say Indian Income Tax Act does not allow, but US allows it, UK does not allow it, France will allow it. So I cannot go by income tax specific at least in general, unless they specify in the problem. So what we should do, let's look at logically, conceptually, theoretically. It is an expense for the company. Should we take it into tax benefit? Yes, it's an expense. So tax benefit should be considered. So I will write tax benefit on above, on call premium. So when you have expense, you save tax. Save tax indirectly means cash flow will increase, saving tax. So 4,50,000 into 40%, 1,80,000. Don't write within brackets. You can keep it in positive number, 4,80,000, 1,80,000. You can also do one more method, my dear friends. Instead of doing these two separate calculation, directly you can do. You know what is the concept? How do we convert before tax into after tax? We multiply by 1 minus t. Remember that basics? I may not have told you. I think you know it. To convert from before tax into after tax, I multiply by 1 minus t. So 4,50,000 into 1 minus 0.4, 1 minus t. So 4,50,000 into 1 minus 0.4, I think you get 2,70,000. Now 4,50,000, 1,80,000, net also 2,70,000. So you can show that way also. I hope you understood both the way of presentations, and I hope you're writing it parallelly with me. So tax benefit, this also 0. Everywhere 0 only here. Continue old bond. Okay. Now, what else is relevant in old bonds? Okay. In old bonds, we had issued at a discount of 30 per bond, and initial flotation cost was 3,60,000. Is this flotation cost, issue expenses allowed in income tax? I know you will say yes, allowed for 10 years and all, or 5 years and all. We are not going by that logic. We are not worried about income tax specific provision. Let us think logically. What is the logic? I am raising a bond, I am taking a loan having a maturity of 10 years. And for that, I am incurring these expenses. So this expense is for getting this loan, and so this is not a one today's benefit only. This expense is to take this so much of source for 10 years. The loan will be available with us for 10 years. So this expense, what is incurred today, should be allocated over life of the bond, not as per Income Tax Act, but as per logic. So this expense incurred is relevant for the loan. Loan benefit I get throughout the life. So this expense benefit I get throughout the life. Matching concepts. When I get the benefit, I have to recognize expense. So this loan is for 10 years. So for 10 years, I use the loan, I get the benefit. And this expense, indirectly, I'm getting the benefit for 10 years, that is life of the bond. I have to spread across life of the bonds. So what is the flotation cost? 3,60,000, discount 30 per bond. How much 30 per bond means? 30, I think 30 per bond means, I think it comes to 9 lakh, I think. Anyway, I'll show you the calculation. This flotation cost and the discount amount, I don't have to take it now. Cash flow, it was already done. It was already paid. When is what paid? These cash flows were already considered when the old bonds were initially issued. Cash flow was taken, but tax benefit was not taken. Why tax benefit was not taken? Because that was not taken to tax immediately then. It was spread across 10 years. It was supposed to be spread across 10 years. That's how you have amortized. But Now it is getting curtailed at the 5-year end only. So even this amortization has to be curtailed. We will take the tax benefit immediately. What do you mean by this? Listen to me carefully. This concept, many people are not clear from my experience. History. This old bonds was issued 10 years back, and when this 10 years back issue was taking place, we have incurred some expenses. Cash flow was already out. Happened. History. But that expense, tax benefit was not considered because logically it should be spread across 10 years life of the bond. But now the bond is getting redeemed immediately. Don't worry about the new issue yet. It was amortized over a period of 10 years. Now it is redeemed in a shorter period, redeemed immediately after 5 years. So we have amortized for 5 years and 5 years pending. Even these expenses, which is amortized 5 years, no problem. But what is pending 5 years, we will recognize in expense in P&L immediately. Whether income tax allows or not does not matter. I'll repeat once more. The issue expenses amortized over life of the bond. But because the bond is redeemed immediately, whatever unamortized cost is there, that also should be taken to income tax immediately. Whenever loan is there, this expense is amortized. Loan redeemed immediately, this expense also amortized immediately. This we call it as tax benefit on unamortized cost. Unamortized cost. Tax benefit on unamortized cost. If you continue with the old bond, this will not come. Why? You will continue to amortize over remaining 5 years because bond loan is still there. Bond is still there. But when you redeem the bond immediately, the corresponding unamortized expenses also to be taken immediately. The cash flow part I will not take. Only tax benefit I will take. Why? Cash flow part was already taken when the issue have taken place. This adjustment is very important. Mark it important and do revise frequently. That's how you should do smart revision, my dear friends. You can't do everything when you go for revision. Like this, identify the areas which are critical. Whichever critical in my opinion, I will tell you. And whichever you feel also, mark it. So when you revise later, you should focus on these critical areas so that you don't do these mistakes. You can optimize your marks in exams. Okay, so how much amount? This is issue expenses. Was initial flotation cost 3,60,000. Then a discount. Discount is given to be 30 per bonds. How do you calculate? 3 crore divided by 1000 into 30. Just like I computed this now, 15 rupees. Same way, 3 crores divided by 1000 into 15. I think you get double of that, which is 9 lakh, I think. 3 crore divided by 1000 into 30. So total is this is 9 lakh plus 3 lakh 60, 12 lakh 60,000. This was spread across 10 years. So divided by 10, amortized for 10 years. But 5 years over already. So we have already amortized 5, remaining 5. This is 10 minus 5 you say. remaining 5, 10 minus 5, remaining unamortized cost, multiplied by tax benefit 40%. So 12,60,000 into 5 divided by 10 into 0.4. 2,52,000 tax benefit. So it's a positive number. This you can say like a working note. So 2,52,000 is the number. Write it slowly. Take 2 more minutes. This is a critical calculation in this problem or in this variety of problem. 12,60,000 is the cost spread across 10 years divided by 10. Unamortized. So remaining, now multiplying by 5 years, remaining 5 years, and tax benefit 40%. Let me know if any amount here needs to be explained. Okay, I hope you got it. So these are all the old bonds. What about new bonds? Issue of new bonds. 0. I think face value is same. That is 3 crores. Since it is issue, we get the amount 3 crores. And issue expenses of new bonds. Issue expenses of new bonds. 2 lakh. Outflow. Issue expenses 2 lakh. But whenever there is an expense, we have to consider the tax benefit. But tax benefit, I don't take it now. Can you tell me why? Issue expense I'm taking, it's tax benefit, I am not taking it now. Then when will I take it? Call premium, I've taken the tax benefit immediately. But this issue expense I'm incurring today, but I'm not taking the benefits immediately because the bond has life of 5 years. Matching concept. This should be amortized over remaining period of 5 years. That's what I have done for old bonds also. But because old bonds are redeemed immediately, whatever the pending portion I recognized immediately. Now this bond also 2 lakh issue expenses will be spread across remaining 5 years. But after 2 years, suppose after 2 years, if I redeem immediately, then this remaining expense also would be redeemed immediately, recognized immediately at the time of redemption. Hope you are getting the concept. Okay. Then issue expense is done. Issue of new bond is done. There's one overlapping interest. Overlapping interest. What is overlapping interest? They said in the problem, new bonds shall be issued 2 months before retiring the old bonds to avoid any market risk. In the sense, it will not happen immediately. It's like repay old bonds, in the same fraction of a second, take new bonds. That's not happening. There is a time gap. You issue the bonds, let the money come in, and then you redeem the old bonds. This process will take 2 months. And in this 2 months process, you have to pay interest, which you cannot avoid. So this is an additional interest burden if you go for replacing with the new bond. Sir, had I continued with the old bonds also, these 2 months would have been my interest cost. No, don't think like that. Once I get the bond, that will be there for 5 years. In the sense, the old bonds also there, new bonds also there for those 2 months. So for those 2 months, you are paying extra interest under old bonds. That extra interest would not have come. Therefore, overlapping interest will come with respect to old bonds, but in the second alternative. So on 3 crores multiplied by what is the rate of interest? 14%, I think. Existing bonds, 14%. For a period of 2 months. So into 2 by 12. And this I'll take directly after tax. Again, I don't want to do two calculation. Interest and tax. I can do, but I don't have space. So directly I'll do after tax 1 minus 0.4. It's an outflow. So show within brackets. So 3 crores into 14% for 2 months after tax. I think you get 4,20,000. So this is 0 and this is add everything. 3 crores minus 4,50,000 minus 1,80,000 plus 2,52,000 plus 2 lakh minus 4,20,000 minus. I think minus only will come still. I think 6,38,000 minus 6,38,000. So what is the incremental? Only these two amount I am doing. That is 6,38,000. Incremental initial cash flow within brackets. So I'm doing second column minus first column. Replacement with the new minus continue with the old. Second column minus first column. Initial cash flow. Only initial cash flow is lengthier. Other part is not so lengthier. Okay. Any doubts, my dear friends? Any doubts you will have it here only. One doubt will come in interim. I will explain that later. But the complication arises only here. Okay. I believe you are clear. If I was slightly harsh earlier, please pardon me. My job, my duty to explain any doubts you ask. So don't have any apprehensions. Get your doubts clarified. Understanding is more important. Reactions of various people is not important. Okay. Okay. Next, I will have interim cash flow. Same two heading. Continue with the old bond. You can continue. I am writing fresh slide, so I'm writing. So continue with the old bond. That's one alternative. Or replace with new. Increment. Okay, so moving on, interim cash flows. So what cash flow we get every year? One is obviously the coupon payment, interest payments, and I'll take it after tax so that you can do direct calculation. 3 crores. Previously it is 14%, and now it is going to be issue the new bonds with 12%. Okay, so interest payment with the old bonds 3 crores into 14% after tax into 1 minus 0.4. 25 lakh 20,000 within brackets. Then new will be 12%. So 3 crores into 14% into 1 minus 0.4. No, so 12%, not 14, 12%. 21 lakh 60,000. Okay, so can you tell me what is the difference between these two numbers now? Incremental amount, what is the difference between these two now? It is definitely 3,60,000. But please tell me, is it plus 3,60,000 or minus 3,60,000? Inflow or outflow? It is plus 3,60,000. Inflow, savings. Don't get confused by minus here, minus here. You can do it in multiple ways. First of all, the purpose of this redemption and issue of new bonds is this savings in interest. It has to be benefit. This is the primary benefit. If this itself is cost, this topic itself is not required. Mathematically, I will tell you, this is second column minus first column. So minus 21 lakh 60,000 minus of minus 25 lakh 20,000, which is plus 25 lakh 20, you get plus 3 lakh 60. Logically speaking, 25 lakh 20 outflow with the old bonds, 21 lakh 60 with the new bonds. So outflow is reduced, means benefit. Whichever way you understand, write the correct number. Or in fact, you don't have to show these calculations also. Directly you can do, no, 14% you used to pay earlier, 12% you pay now, 2% saving, 3 crores into 2% into 1 minus tax, directly you get 3,60,000. That way is also fine. Okay, important element is this amortization of issue expenses and discount. Amortization of issue expense, and I'll do one more separately. Amortization of discount. You can do together also. I'm showing it detailedly possible. You can do it together to save time in exam. So what was the old bond issue expenses? old bonds, initial flotation cost of 3,60,000. So 3,60,000 divided by 10. But issue expense is not the criteria. Tax benefit is the criteria. So multiplied by 40%. Tax benefit, amortization, tax benefit. To be specific, you can say tax benefit. So 3,60,000. This 3,60,000 is different from that 3,60,000. Okay, we are not talking about this 3,60,000. We are talking about issue expense 3,60,000. This number, initial flotation cost 3,60,000. We are talking about that. 14,400. Sir, one doubt. What is that? This 3,60,000 by 10, we have already taken, right? This 3,60,000 here, issue expenses divided by 10, I've already taken into 40%. No, that was taken in the second column. That is, if you go ahead with the decision of replacement. If you don't replace, you continue with the old bond, it will not be part of initial cash flow. It will be part of annual cash flow. That's what I am taking now. Understanding? I'm taking in the first scenario of continuing with the old bonds. What we have taken earlier is second scenario. Continue replace with the new bond. If you replace with the new bond, it will not come in interim cash flow. It will come in initial cash flow itself. Hope you got the clarity. Anyway, if you have doubt, I can still clarify later. Okay, discount was what was the discount amount? 9 lakh. So 9 lakh divided by 10, 90,000 into 40%. I think 36,000. Still 5 years are left. Why not 5 years amortization? I will take 5 years amortization, but this is annual, my dear friends. Why you did not ask the same question with respect to interest? I applied 14% on 3 crores or 12% on 3 crores. Should I not multiply it by 5 years? What do you think? Interest I've taken only for 5 years. Why not for I've taken only for 1 year? Why not multiply it by 5? Because I am calculating annual cash flow. I'm calculating annual cash flow. Annual. Then can I multiply it by 5? No. Every year time value of money is different. So I multiplied by discounting factor, which means here I multiplied by annuity factor. So I don't multiply it by 5. I will multiply it by annuity factor of 5 so that I get the present value later. But as of now, I am calculating annual interest, annual amortization, annual incremental cash flow. Okay. So 36,000 here, 14,400, and I am only tax benefit I'm taking. Every year tax benefit I'm taking. And if I replace with a new bond, there is no discount, but you have amortization. Issue expense how much? 2 lakh, right? New issue cost 2 lakh. Okay. So this 2 lakh will be spread across 5 years. So 2 lakh by 5 into 40%. I think 16,000. We discussing right earlier. That is 2 lakh we had taken in the initial cash flow, but tax benefit I have not taken. Why? I'm taking it now. So incremental 16,000 minus 14,400. So 1,600 benefit. 0 minus 36,000. So 36,000 loss. Okay, I'll explain this once more. Mathematically, 16,000 minus 14,400, second column minus first column. Second column minus first column, positive. And here 0 and 36,000. So 0 minus 36 minus 36. Mathematical explanation over. Logical explanation. Earlier we are getting 14,400 benefit. Now I get only 16,000 benefit. That means benefit has been reduced. So benefit reduced means, benefit increased. Earlier 14,400, now 16,000. Benefit increased. Benefit increase means positive inflow. On discount, 36,000 was benefit earlier, but if I give it the new loan, new benefit, I don't get anything. Therefore, I don't apply. I don't get any benefit. So benefit is lost, outflow. So what is the incremental interim cash flow? On annual basis, of course, 3,60,000 plus 1,600 minus 36,000. 3,25,600 benefit. Okay, I'll do a terminal cash flow also here because there is not much thing here. Redemption basically. If you continue with the old bond, you would have redeemed 3 crores. No premium would have come because premium will happen, call premium only when you redeem in advance. If you redeem on time, then there is no premium. So 3 crores. If you continue with the new bonds, that's also 3 crores. So incremental, I can say 0. Nothing. 0 terminal cash flow. So we have calculated how much initial cash flow incrementally, interim cash flow incrementally, terminal cash flow incrementally. Everything incremental we calculated. But I cannot add everything because of time value of money. So we'll prepare our regular tabular format. We'll compute the net present value. Hope you have done till here. And again, I repeat, this amortization part is important. Many people have a confusion there. This amortization part is important. Okay, let's go further. NPV computation, regular format, year, cash flow, discounting factor, discounted cash flow. So initial cash flow, interim cash flow, terminal cash flow, all incremental. So initial cash flow is year 0 because taking place today. Interim cash flow year 1 to 5, every year same amount. So directly I can write. And terminal cash flow comes on the last year. And first calculation we have done, that is 6,38,000. 6,38,000, right? Yeah, 6,38,000 outflow. Interim cash flow we calculated 3,25,600. And terminal cash flow 0. Okay, discounting factor. What is the discounting factor? What is the required rate of return? What is the cost of capital? Not given. When cost of capital not given, discounting rate not given, if they give, we'll take it. When the discounting rate not given, what do? We'll take the current rate, incremental borrowing rate. That is, today what is the rate of interest? Coupon rate only, borrowing interest rate. No, you are paying 12% for the coupon, means that should be the market rate today, or that should be the rate applicable for you today. But one small point, adjustment required. Can you think what could be that? Cost of capital directly not given. So we'll take the present applicable rate. That is present coupon rate. But this is before tax, but all our calculation after tax. Therefore, we have to do multiplied by 1 minus t. So 12 multiplied by 1 minus 0.4, that is 8.4. No, 7.2, I think, after tax. Yeah, 7.2. Remember, because we are using coupon rate, we need to convert into after tax because cash flows are all after tax. Discounting factor also should be after tax. But in the problem, if they give you cost of capital of the company 7%, then you take that 7% directly as discounting factor. Don't do 1 minus t, because when they give you cost of capital in the problem, that itself will be after tax, right? Okay. Now, first year discounting factor is anyway 1. Then annuity factor, calculate how much annuity factor. 7.2% for 5 years. Point 40783. 4.0783. 4.0783. 4.0783. And last year discounting factor does not matter, but still 0.7064. 0.7064. This anyway is 0. This anyway is 6,38,000. 3,25,600 into 4.0783. 13,27,894. So NPV, incremental NPV, incremental benefit, net benefit. Is 6,89,894. So NPV is positive, incremental benefit is positive. So bond should be replaced. Bond should be replaced. Okay. One of you are asking the question, why I'm not multiplying by 5? Hope you got the answer. Because annual cash flow, I'm multiplying by annuity factor. Thereby, 5 years effect is considered. Okay. So that's a typical problem, a replacement problem. There's one small difference that I have, but I have not shown you in the calculations. I have shown you what institute has shown. In the exam also, you can write the same solution. But one difference of opinion I have, which you can also write that in examination, that is regarding tax. That is, okay, you want previous slide? I'll show it to you, no problem. Okay, so I'll just go back what I was explaining, what difference of opinion I have. So if you look at this one, this tax benefit on call premium and tax benefit on amortized cost. I agree tax benefit should be considered, but in my opinion, tax benefit should not be considered immediately. The reason being, tax returns will be filed only at the end of the year. In the sense, you will be paying the tax only at the end of the year. So tax benefit also you'll get only at the end of the year. So in my opinion, these two tax benefit has to be multiplied by first year discounting factor. My opinion. But institute has not done like that. Maybe the argument is no, you pay that advance tax immediately. So matching concept, expense you recognize, tax also you recognize. Matching concept. Maybe that is the logic. But my one small difference of opinion is it should have been multiplied by first year discounting factor for these two tax benefits, because tax benefits you get only at the end of the year. Anyway, you don't have to write that in exam. I just told you for your reference. Okay, so I'm showed you all the slides. Okay, so that's it with this problem, replacement problem. Any doubts? Shall we go further? Okay, let's go further. This problem will be on convertible bonds. Let's try to understand. Let's read the problem. Along with that, I'll try to explain the concept and also some more concepts than what is just asked. I hope you got the question first. A convertible bond with a face value of rupees 1000 is issued at 1350 with a coupon rate of 10.5%. Conversion rate is 14 per share per bond, 14 shares per bond. Current market price of the bond and the share is 1475 and 80 respectively. What is the premium over conversion value? Simple meaning of convertible bonds you can make out of the name itself. Convertible bonds. Bonds that can be converted into shares. If you are a bond, you are a bond holder. If you convert to share, you become shareholder. Bond holder, you receive interest. Once you convert to share, you receive dividends. So here we are going to talk about what are the terminologies associated with that. First, the most predominantly asked term is premium. Now, premium can be expressed in three ways. Premium in percentage, premium per bond, premium per share. You can express in different ways. First, let me do a quick comparison. What is the market price of convertible bonds? Market price of convertible bond. Have the given market price of convertible bond? Current market price of the bond is 1475. Okay, that is, if you are a bond holder, if you remain as a bond holder, your investment is worth 1475. Simple market price of convertible bond. Now just imagine you convert from bond into share. What is that value you get? That's called as conversion value. Conversion value. What is the value if you convert into shares? Self-explanatory. Formula not required. Conversion value. How many shares you get? 14 shares. What is the value of each share? 80 rupees. So 14 into 80 rupees. How much is that? That's the formula if you want. Number of shares, conversion ratio. Number of shares means conversion ratio into market price per equity share. So 80 into 14. 1120. So if you convert into shares, that's called as conversion value. If you remain in bonds, that's called as market price of the bond. So what is the difference? Market price of convertible bond minus conversion value 1475 minus 1120 355, right? That is what is called as premium. Because we are comparing per bond, this is premium per bond. That is 355. 355. What is this premium amount? This is premium amount 355. This is the extra amount. Premium means extra amount paid, to remain in bond. Now, at this point of time, when there is premium, you tell me, in this situation, which is a better position? Being in bonds is giving you higher net worth, higher value, or converting into shares is better, where you get 1120. Obviously, being in bonds is better. That is a comfortable position because value is more. But for that, you are paying premium. How much you are paying premium? 355. So, extra amount paid to remain as bondholder is a premium per bond. Okay, we can also express premium in percentage terms, or I'll say premium per share, let's say. Premium per share. Okay, now premium per share 355 is per bond. One bond will give you how many shares? Conversion ratio. One bond will give you 14 shares, right? Therefore, 355 divided by 355 divided by 14. That is the premium per share. Premium expressed in per share term. Premium is for bond only, but expressed in per share terms. So 355 divided by 14, 25.357, 25.36, let's say. 25.36 per share. We can also express premium in percentage. Premium in percentage terms. Okay. This I can do from the bond value or I can do from the share value. If you do from the bond value, that is premium divided by conversion value. That's the formula they say, express in percentage. That is premium is per bond is what we calculated 355 divided by conversion value, that is 1120 into 100. 355 by 1120 into 100, 31.696 or a rate of 31.7%. So I'm paying 31% percentage premium to remain in bonds over and above my share value. I can also express in share basis, or what is per share value? Premium 25.36 divided by what is equity share value 80 rupees multiplied by 100. So 25.36 divided by 80 into 100. 31.7 only you get. 31.7%. Same number, 31.7%. So let me tell you the interpretation once more. We are paying 355 rupees per bond to remain in bond. We are paying that 25.36 per share extra to remain in share. I am paying 31.7% of my equity share extra to remain in bond. So these are the premium amount that I have paid to remain in bond. These are the extra amount over and above equity share value. Or can I say like this, my dear friends? If I convert it to shares, I lose this much value in the process of conversion. This is the extra amount I enjoy because I remain as bond. But if I convert it to share, all these amounts I am going to lose. Okay. So in the question they asked premium over conversion value. You write 355 and answer 31.7. Answer is over. I am trying to explain many more other concepts, taking one simple problem as the basis. Any question? I'm going to expand it further, definitely. Okay, hope you got this point. Shall I take this part out? Because if you ask me to come back to this slide, this will not be there. I'm erasing this part. Please confirm. I would like to do more analysis now. Okay, I'll erase this part. Okay. Now, market price per equity share. Given situation 80 rupees. If I have to make a decision, is it better to convert or not better to convert? Obviously, we have already discussed. Decision is better not to convert. Don't convert to shares. Why don't convert to shares? If you remain in the bonds, you get 1475. But if you convert to shares, 14 into 80, your value will be reduced to 1120. So don't convert. Okay. Now tell me, if market price per share becomes 90 rupees, then what do you think? Is it better to convert? What will be the conversion value? You will calculate conversion value, right? How much it will become? Conversion value 90 rupees into 14. 1260. Still lesser than 1475. So again we say don't convert. Okay. Now let's say share price becomes 120. Now what do you think? 120 into 14? 1680. It is more than 1475. Now we'll say converts. Because when you convert it to shares, you have got a better investment value. Okay, now here comes the question. Instead of calculating like this, why don't I compute a price in which my bond value and share value both are same, like a indifference point, so that if the share price crosses that indifference points, convert. If the share price is below that point, we say don't convert. Instead of going by situation basis, it's a better scientific approach to calculate the price at which bond price is equal to share value. If you cross that number, then convert to share. If you don't cross it, we remain in bonds. That's called as parity price. Conversion parity price. What is parity, Parvati and all? In English, parity means something equal. So parity means price at which conversion does not matter. That is, bond value is equal to conversion value. Share price at which bond value is equal to conversion value. How do we calculate? The formula that is given by market price of convertible bond, divided by ratio, conversion ratio, number of shares. What is the market price of convertible bonds? 1475. Divided by, what is the conversion ratio? 14. So 1475 divided by 14. 105.36. Which means if market price of the share is 105.36, whether you convert or not convert, same position. If share price is beyond 105.36, it's better to convert. If the share price is below 105.36, then don't convert, remain in bonds. If you want, convert it or write that one sentence. Detail you don't have to write. I'm sure you can understand. I'm sure this one sentence you can understand. Write that sentence. Conversion option is beneficial. Conversion option is beneficial only when market price of equity share. Conversion option is beneficial only when market price of equity share 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 goes beyond 105.36. Goes beyond 105.36. Goes beyond 105.36. Goes beyond 105.36. Hope this one sentence sufficient. If it is lesser than, don't convert. If it is equal to, does not matter. Indifference point. If you want, you can also write. This is indifference point. Indifference price, indifference point. Equal, parity, both are equal, both are same. So if it is 110, 112, 120, we accept. 90, 80, 75, 104, we don't convert. Sir, what will happen once I convert? If the share price come down, you can't come back to bonds. That is the limitation you have to accept. But at least we are making a decision at which point it's better to convert. I'm going to do some more analysis, but any questions from your side? Okay, hope you're clear. Okay, I'll take this part out. I will explain once more, or I'll explain, then I'll take it out. Now tell me this. If the share price becomes 105.36, what will happen to the premium? What is the meaning of premium? Extra amount I pay to remain in bond, where bond is beneficial. Now, if market price becomes 105.36, what is the premium I get? No premium, right? No premium should be there. In other words, can I say like this? Parity price is equal to whatever is the conversion, whatever is the current share price plus premium. Because, or in the parity price, premium will not be there. So I can say like this, parity price, premium will not be there. So minus premium should give you the existing share price, current share price, existing market price per share. So we can also calculate like this. So what is the parity price equal formula if you want to write? Parity price equals existing market price per share plus premium per share, of course. What is existing market price per share? 80 rupees. What is the premium? We already calculated premium per share. How much was it? 25.36, right? 25.36. That is what we get 105.36. Because premium should not be there. Premium element no longer should be there. So existing market price, if I add premium, then bond and share becomes equal. I'll explain once more. Bond is higher, share is here. So you are paying premium to remain in bond. If shares also increase by same amount, then share and bond become same. Understand? Bond is here, share is here. Because bond is high, there is a premium. If shares also increase by that much of premium, if shares increase by that much of premium, then bond will not have any premium. Bond and share both become equal parity price. You can also express in percentage terms. So parity price, you can also calculate in percentage terms. So existing market price per share plus percentage premium. Then also you get the answer. What is existing market price per share? 80. What is the percentage premium? We calculate 30, some percentage. 31.7%, right? 31.7%. Apply 31.7% on 80. So you get 80 plus 25.36. That is 105.36. 105.36, which means I'm going to dictate one interesting sentence. First you write down till here, then we'll write that sentence. I'm sure you will like it. Okay, hope you written down here. Write down that sentence. Equity share, market price, equity share, market price should increase by at least 31.7%. Should increase at least by 31.7%. 31.7%. Should increase at least by 31.7% to make the conversion attractive. Equity share market price should increase at least by 31.7% to make the conversion attractive. 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 Hope you are understanding this point better. Now, premium, what we're discussing, it is premium to remain in bond. Rather than understanding like that, you understand the premium as how much should the share price should increase so that the conversion becomes more attractive. Try to think on those lines. Previous slide, no, premium calculations I don't have. I told you, my dear friends. I told you clearly, I am erasing the premium calculation out, conversion value out, and don't ask me to come back. Previous slide only I told you, I'm erasing it out, so it's not there. I took it out. Well, taking it also, I told you, I'm erasing it out. So make sure you're done till here. Okay, fine. Hope you got this sentence also. If you don't have any questions, I'll go further. Okay, let me go further. Okay, so hope you got this question. ABC Limited wants to issue 9% redeemable in 5 years at a face value of 1000 each. 9% coupon rate, redeemable after 5 years, and face value 1000 rupees. The annual spot yield curve for similar risk class of the bond is as follows. They have given the heading interest rates. They have given the heading interest rates. But what is the title given? The spot yield curve. So what do you understand? This 12% is for first year. That is clear. And 11.62%, please tell me, is 11.62% applicable for second year or applicable for both the years? 11.62% is applicable for second year or applicable for 2 years. It's applicable for both the years because they said use the word yield. Applicable for both the years, not only for second year. When will you interpret it is only for second year? Only when they use the word forward rate. Forward rate means applicable for that particular year. So these are all like average rates. Evaluate the expected market price of the bond if it has a beta value of 1.1 due to its popularity because of lesser risk. Interpret the nature of the above yield curve and reasons for the same. Use PV factors up to 4 decimal points and in rupees up to 2 decimal points. So how many decimal points to take? The question has given clearly. Beta value. Okay, beta value might be slightly new because we usually know beta only for equity. How come we will have beta for bonds? Here, beta value means more like, remember, like a confidence level. More like a confidence level. You know, in certain brands of the products, you are always ready to pay little bit more. Like if some plain shirt is sold outside a mall in footpath, let's say, if the person says 500 rupees, you tell 500 rupees, so much. You bargain, you negotiate. But if the same shirt is available inside a mall in a AC condition, small tick is there, Nike tick, you know, that tick is there. Brand, you are ready to pay 5000 rupees also. So you always have that confidence, right? Right or not, I'm not commenting here. But you know, there is one perception level. If it is a branded product, we are ready to pay extra also. Branded product, we have that confidence, quality. So similarly, in some bonds, because of its quality, for example, we say like Tata. We have that confidence. If it is a Tata group, we are ready to pay a little bit extra. That little bit extra is represented in beta. So beta 1.1 means if 1 rupee is regular value of a bond, because of its quality, because of its confidence, maybe because of the group it belongs, or in general reputation it carries, people are ready to pay 1.1 rupee for it. For 1 rupee worth product, we will pay 1.1. So that extra thing is what is called as beta in the context of bond valuation. There is no particular calculation here. These are all derived number, implicit numbers, so should be given in the question. Practically, it's more like a assigned value, not really a computed value. Or we compute intrinsic value, we compute market price, and then the difference we will interpret as beta. That is the confidence level we would like to apply. But from exam point of view, if any beta to be applied, they will give it to you in bond valuation. Equity valuation is a different matter. We'll come to it when we come to portfolio chapter. So evaluate the market price. If beta value 1.1 means we'll compute the present value. And once we compute the present value, and then we are going to multiply it by beta, that will give us the market price. Hope you got the overall idea behind it. Okay. So what we have to do now? This is having maturity of 5 years. So present value is calculated as, or intrinsic value, present value, intrinsic value, let's say, intrinsic value. Present value is calculated as 5 years maturity. That is, how do you do? First year coupon divided by 1 plus YTM of first year. I usually used to do 1 by 1 plus K, but now multiple discount rates are there. So we have to be specific. Plus C by 1 plus YTM of year 2, different number, and whole square. Sir, why you are not using 1 by 1 plus FR1, FR2? Because they have not given forward rates. They have given YTM. We are making use of YTM. Plus third year C by 1 plus YTM of year 3 whole cube, third year YTM discounted. If it is forward rate for third year, then 1 plus FR1, 1 plus FR2, 1 plus FR3. But this is YTM given, straight away you can take the cube of it. Fourth year C plus 1 plus YTM 4 to the power of 4. And last year coupon also you'll receive, redemption value also you receive, divided by 1 plus YTM of year 5 whole to the power of 5. We can also solve the problem in tabular method. Year, cash flow, this numerator whatever is there, that is cash flow. And denominator whatever is there, 1 by 1 plus YTM 1, 1 by 1 plus YTM 2 square. These are all going to become discounting factor. Then we multiply the two, we add all, same thing, equation only we get. So C, coupon on 1000, 9%, that is 90. So every year 90. And last year, along with redeemable value, so last year I'll take 1090. So first year YTM, 12%, 1 plus 0.12. Second year YTM, 11.62. So 1 plus 0.1162 square, because second year YTM should be squared. Third year, 11.33. So 1 plus 0.1133 to the power of 3, because third year discounting factor, plus 11.06. So 1 plus 0.1106 to the power of 4. last year 10.8, 1 plus 0.108 to the power of 5. How do you do in calculator? Straightforward, you can calculate like 90 divided by 1.12. Or they also said take 4 decimal points, no? But okay, you can approximately take it. Just 1 second, just give me 1 second. Okay, let's calculate separately. 90 multiplied by, they said 4 decimals, no? I could have calculated directly, but they want us to show the calculation. Let's do. So 1 by 1.12, 0.8929. This would have become, if you follow the discounting, the columnar method, this would have become discounting factor of year 1 plus 90 into 1 by 1 by 1 point 11 point 1 by 1.1162, 1 by 1.162 square, so equals 0.8026, 0.8026, which is nothing but discounting factor of year 2 plus 90 into 1 by 1.1133 cube, 123, 0.7247, then 90 into 1 by 1.1106 to the power of 4, so equal to 4 times 1 2 3 4, 0.6573, and 1 by 1.108 press equal to 5 times 1 2 3 4 5, 0.5988, 1090 into 0.5988. Using M plus MRC, we could have got the total directly, but since they said ask you to calculate like this, decimals up to 4 decimal points, we are showing like this. This you can also present in a columnar format. This 90, 90, 90, 90, 90, 1090 becomes the cash flow column. 0.89, 0.8026, 0.7247, 0.6578, 0.59988 becomes a discounting factor column. And when I multiply these two, I get DCF column, that is present value column, and the total will give us the intrinsic value. So we can present in horizontal format, or we can also present in our regular vertical columnar format. So 90 into 0.8929, 80.36, 90 into 0.8026, 72.23, 90 into 0.7247, 65.22, 90 into 0.6573, 59.16, 1090 into 0.5988, 652.69, and add all and see what you get. Nine 29.6667. 929.66. 929.66. This is the intrinsic value, and they said compute the market price. So we'll multiply it by beta. So market price is intrinsic value multiplied by beta, 929.66 into how much extra they had to pay, 1.1 times. So into 1.1. 1022.626 or 63. 1022.63. Beta is the risk, correct, but that is a different interpretation in equity, different interpretation in debt. I think we explained at the beginning of the problem. Beta in the context of bond valuation represents confidence level. Because the risk is less, people are ready to pay more. So beta represent risk, but in a different level in bond valuation and in a different meaning in equity valuation. But here it represents the confidence level I told you. If 1 rupee is intrinsic value, people are ready to pay 1.1 rupee for it. They are ready to pay more because risk is less, because their confidence is more. So you just have to multiply it by beta to get the market price. Beta in bond valuation is different. Beta in equity valuation is different. Yes, definitely it has different meaning in different place. That's what I told you at the beginning of my classes also. SFM is not a law. We don't have rules. We have interpretation for decision making. You definitely don't use only one meaning across in your practical life also. So we have to do our interpretation depending on the context. In the third step, instead of dividing 90 by denominator, why we have multiplied it? Okay. Then I have to go back to my class 1. I thought these kind of questions will not come in my basics. That's why in the basics classes I have covered those. And then if I have to still explain, I will do it. But even in explanation, my basic class also was not supposed to be there because that is basic mathematics. Okay, let me teach basic mathematics, no problem. In mathematics, A divided by B is called as fraction. And the number above is called as numerator, the number below is called as denominator. And we can also write like this as A into 1 divided by B. This is the property in mathematics. Instead of writing B in denominator, I am writing it as 1 divided by B. And how do we calculate present value? The formula what we have is future value divided by 1 plus r to the power of n. Because future value is multiplied by 1 plus r power n. So present value means that should be divided. And we will write it as future value into 1 divided by 1 plus r to the power of n. Future value, keep it aside. And 1 by 1 plus r power n, that is being multiplied. Even though it is multiplied, it has the impact of division. And this 1 by 1 plus r power n is what we write it as discounting factor. So if you write in an equation format, all our bond valuations, present value, equation format, we write it as coupon of first year divided by 1 plus r. plus coupon of second year divided by 1 plus R square. This is equation format, or cash flow by 1 plus R, cash flow by 1 plus R square. If I write this in a tabular format, year, cash flow, discounting factor, discounted cash flow, year 1, year 2, cash flow of year 1, cash flow of year 2, coupon, then 1 by 1 plus R, what I get is first year discounting factor. 1 by 1 plus R whole square, what I get is second year discounting factor. The same equation format can be expressed in tabular format. Cash flow column, this column what we have is the numerator column. And what we have here, 1 by 1 plus R and 1 by 1 plus R square, these are all the denominator column. Why do I multiply? Because I'm not writing only 1 plus R. I'm doing 1 by 1 plus R. So this part I'm doing 1 by 1 plus R and 1 by 1 plus R square. So when I multiplied by 1 by 1 plus R, actually I'm dividing by 1 plus R. I'm multiplying by 1 by 1 plus R square. That is, I'm dividing by 1 plus R square. I repeat once more, multiplying by 1 plus R is equal to dividing by 1 plus R, and 1 by 1 plus R is what we are calling it as discounting factor. So when I multiplied by a reciprocal, when I multiplied by a discounting factor, effectively it is actually getting divided. So in our calculation, when I do 1 divided by 1.12 as 0.8929, I have taken into numerator, it has become multiplier. So multiplying by 0.8929 is same as 1 divided by 1.12. Dividing by 1.12 is the same as 0.8929 multiplying. I hope this will clarify that doubt. I don't mind explaining the basics, but it worries me. This was the elementary foundation of financial management or mathematics, I will say, because I explained so much about discounting factor in my basic classes. We spent so much time talking about the basics. And even then, if that is doubt, it gives me two interpretations. Whether I've explained it correctly or not. Second, whether you don't have any basics. That worries me. Both answers. It really worries me. Okay, let me go further. Interpret the nature of the above yield curve and reasons for the same. You can see the YTM yield. Yield is 12, 11.62, 11.33, 11.06, 10.8. So basically it means the yield is coming down. Just for the clarification, any chance if we directly divide 90 by its denominator, the answer is different. So we need to follow this 1 by 1 plus method only. Okay. You may get some decimal difference if you calculate directly. So your answer might be very close. Some 0.2, 0.3 decimals may be different. Even though computing directly is more appropriate. But in the question they said, I said in my explanation, I don't know whether internet problem or not, I am not explaining things properly. We can calculate mathematically directly by dividing it. In fact, we don't have to show these steps. Directly, I can use 90 by 1.12 equal to m plus 90 by 1.1162 square equal to m plus 90 by 1.1133 equals m plus. Like that, I can calculate directly and MRC will give me the answer directly. Answer I get. Mathematically, I get. May be different from this number slightly. Still, my answer is more accurate. But will I get the marks in exam? You don't get the marks in exam because what is the note they have given? Use a PV factor up to 4 decimal points. When they set this instruction clearly, we have to make use of it. And value in rupees up to 2 decimals. So I have to show the discounting factor and have to show the amounts in 2 decimal points calculations. And I also told this in my explanation while solving the problem. Please show the calculations because they have asked us to round off 4 decimals for discounting factor, 2 decimals for calculations. And I also told, had you showed this in a columnar format, this question would not have arisen. Year one column we write, cash flow one column we write, discounting factor. So these numbers we write it in separate column. And when we multiply, we get discounted cash flow. So we get these numbers in separate column. So all calculations will be more clearer if you write in the columnar format. Okay. Let me come back to the last part of the question. Interpret the nature of the above yield curve and reasons for the same. Interesting yield curve because you observe 12, 11.62, 11.33, 11.06, 10.8. Usually I told you in the yield curve, it goes like this, right? Higher the maturity period, higher will be the yield, higher will be the maturity period, higher will be the yield, and after a particular point, yield will get constant. That's what we have discussed theoretically. But here you see, higher the maturity period, lower the interest rates. So it's actually yield curve will be like this. Initially interest rate is high and subsequently less and get stabilized like this. This is not normal. This is definitely abnormal. We call this as inverted yield curve, opposite, reverse. And why will this happen? So in the coming years, people are expecting lower interest rates. So when your expectation is lower and lower interest rates, and that is when the inverted yield curve will happen. So interpret the nature of the above yield curve and reasons for the same. So you can write down that. Yield curve is in the nature of yield curve is in the nature of inverted yield curve. Yield curve is in the nature of inverted curve. Yield curve is in the nature of inverted curve. Inverted curve. Inverted curve. This is because this is because of interest rate expectation. This is because of interest rate expectation to be falling. Interest rate expectation to be falling in the coming years. To be falling in the coming years. To be falling in the coming years for reasons such as for reasons such as for reasons such as economy level, business cycle, etc. So economy level, business cycle, etc. That is, economy is coming down or business cycle is reaching recession stage, and that's where we are expecting a lower interest in the coming years. Okay, so hope you get these points. Let's go further.